1. Introduction to index funds. 1.1 What are index funds? Index funds have gained significant popularity among investors in recent years. These investment vehicles offer a simple and cost-effective way to gain exposure to a broad market index, such as the S&P 500 or the Dow Jones Industrial Average. In this section, we will explore what index funds are, how they work, and why they have become a preferred choice for many investors. Definition and structure. An index fund is a type of mutual fund or exchange-traded fund (ETF) that aims to replicate the performance of a specific market index. Unlike actively managed funds, which rely on fund managers to select individual securities, index funds passively track the holdings and weightings of a particular index. This means that the fund's performance will closely mirror the performance of the index it tracks. Index funds are designed to provide broad market exposure, allowing investors to participate in the overall growth of the market. They typically hold a diversified portfolio of securities that closely matches the composition of the underlying index. For example, an index fund tracking the S&P 500 will hold the same stocks in the same proportions as the index. Benefits of index funds. Index funds offer several advantages that have contributed to their popularity among investors. Low costs. One of the primary advantages of index funds is their low expense ratios. Since they aim to replicate the performance of an index rather than actively manage a portfolio, index funds have lower operating expenses compared to actively managed funds. This cost advantage can significantly impact long-term investment returns. Diversification. Index funds provide instant diversification by holding a large number of securities. By investing in an index fund, investors gain exposure to a wide range of companies across different sectors and industries. This diversification helps reduce the risk associated with investing in individual stocks. Consistent performance. Index funds tend to deliver consistent performance over the long term. While they may not outperform the market in bull markets, they also tend to provide downside protection during bear markets. By closely tracking the performance of the underlying index funds eliminate the risk of underperforming due to poor stock selection or market timing. Transparency. Index funds disclose their holdings on a regular basis, allowing investors to see exactly what securities they own. This transparency provides investors with a clear understanding of the fund's composition and helps them make informed investment decisions. Ease of use. Index funds are easy to buy and sell, making them accessible to both individual and institutional investors. They can be purchased through brokerage accounts, retirement plans, and other investment platforms. Additionally, index funds offer the flexibility of being able to invest in specific market segments or asset classes. Limitations of index funds. While index funds offer numerous benefits, it is important to consider their limitations as well. Limited upside potential. Since index funds aim to replicate the performance of a specific index, they are unlikely to outperform the market. While this can be seen as an advantage during bear markets, it means that investors may miss out on the potential for higher returns that can be achieved through active management or concentrated investments. Lack of flexibility. Index funds are designed to track a specific index, which means they cannot deviate from the index's composition. This lack of flexibility can be a disadvantage in certain situations, such as when market conditions change or when investors want exposure to specific sectors or industries. Inclusion of underperforming securities. Index funds include all the securities in the underlying index, including those that may be underperforming. This means that investors are exposed to the performance of all the companies in the index, regardless of their individual financial health or prospects. Market fluctuations. Index funds are subject to market fluctuations and can experience periods of volatility. While they provide diversification, they are still influenced by overall market conditions. Investors should be prepared for short-term fluctuations in the value of their investments. Conclusion. Index funds have revolutionized the investment landscape by offering a low-cost, diversified, and transparent investment option for investors. They provide a simple way to gain exposure to the overall market or specific market segments without the need for active management. While index funds may not offer the potential for outsized returns, they have proven to be a reliable and efficient investment vehicle for long-term investors. In the following sections, we will explore the advantages and disadvantages of index funds in more detail, as well as provide guidance on choosing the right index fund for your investment goals. 1.2 Advantages of index funds. Index funds have gained significant popularity among investors in recent years, and for good reason. These investment vehicles offer several advantages that make them an attractive option for both novice and experienced investors. In this section, we will explore the key advantages of index funds and why they have become a preferred choice for many. 1. Diversification. One of the primary advantages of index funds is their inherent diversification. An index fund is designed to replicate the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. By investing in an index fund, you gain exposure to a broad range of securities within that index. This diversification helps to spread the risk across multiple companies and industries, reducing the impact of any single stock's poor performance on your overall investment. Diversification is crucial because it helps to mitigate the risk associated with investing in individual stocks. By investing in an index fund, you are essentially investing in a basket of stocks, which reduces the impact of any one company's poor performance on your portfolio. This diversification can help to smooth out the ups and downs of the market and provide more stable long-term returns. 2. Lower costs. Another significant advantage of index funds is their low cost compared to actively managed funds. Index funds are passively managed, meaning they aim to replicate the performance of a specific index rather than trying to outperform it. This passive approach eliminates the need for expensive research, analysis, and active trading, resulting in lower management fees. Since index funds aim to match the performance of an index rather than beat it, they have lower turnover rates. This lower turnover reduces transaction costs, such as brokerage fees and taxes, which can eat into your investment returns. Additionally, index funds typically have lower expense ratios compared to actively managed funds, making them a cost-effective choice for investors. 3. Consistent performance. While index funds may not deliver the same level of returns as some actively managed funds during bull markets, they have consistently demonstrated competitive performance over the long term. Research has shown that the majority of actively managed funds fail to outperform their respective benchmarks consistently. In contrast, index funds provide consistent returns that closely track the performance of the underlying index. By investing in an index fund, you eliminate the risk of underperforming the market due to poor stock selection or market timing. Instead, you capture the overall market returns, which have historically shown steady growth over time. This consistent performance can be particularly beneficial for long-term investors who prioritize stability and steady growth over short-term market fluctuations. 4. Transparency. Index funds offer a high level of transparency, which is another advantage for investors. Since index funds aim to replicate the performance of a specific index, the holdings of the fund are publicly disclosed. This transparency allows investors to know exactly what securities they are investing in and the weightings of each holding. The transparency of index funds enables investors to make informed decisions about their investments. It also allows for easy comparison between different index funds, making it simpler to choose the fund that aligns with your investment goals and risk tolerance. Additionally, the transparency of index funds makes it easier to track the performance of your investment and evaluate the fund's adherence to its stated investment strategy. 5. Simplicity. Index funds are known for their simplicity, making them an excellent choice for novice investors or those who prefer a hands-off approach to investing. Unlike actively managed funds, which require ongoing research and decision-making, index funds are designed to be low maintenance. Investing in an index fund is as simple as buying shares of the fund through a brokerage account. Once you have invested, you can sit back and let the fund managers handle the day-to-day management. This simplicity is particularly appealing for investors who do not have the time, expertise, or desire to actively manage their investments. 6. Tax efficiency. Index funds are known for their tax efficiency, which is another advantage for investors. Due to their low turnover and passive management style, index funds generate fewer taxable events compared to actively managed funds. This lower turnover results in fewer capital gains distributions, reducing the tax burden on investors. Additionally, index funds tend to have lower capital gains distributions because they aim to replicate the performance of an index rather than actively buying and selling securities. This can be particularly beneficial for investors in taxable accounts who want to minimize their tax liabilities. In conclusion, index funds offer several advantages that make them an attractive investment option for a wide range of investors. Their diversification, low costs, consistent performance, transparency, simplicity, and tax efficiency make them a compelling choice for both novice and experienced investors. By understanding these advantages, you can make informed decisions about incorporating index funds into your investment strategy. 1.3 Disadvantages of index funds. While index funds have gained popularity among investors for their low costs and passive investment approach, they are not without their drawbacks. It is important for investors to be aware of these disadvantages before making a decision to invest in index funds. In this section, we will explore some of the key disadvantages of index funds. 1. Limited scope of diversification. One of the main disadvantages of index funds is their limited scope of diversification. Index funds aim to replicate the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. As a result, they are inherently concentrated in the stocks or securities that make up the index. While diversification is a key principle of investing, index funds may not provide sufficient diversification across different asset classes or sectors. This lack of diversification can expose investors to higher levels of risk, especially during market downturns or when a particular sector or industry underperforms. 2. Lack of flexibility and customization. Another disadvantage of index funds is their lack of flexibility and customization. Since index funds aim to replicate the performance of a specific index, investors have limited control over the composition of the fund. They cannot choose to exclude certain stocks or sectors that they may have concerns about or include specific stocks or sectors they believe will outperform. This lack of flexibility can be a disadvantage for investors who have specific investment preferences or ethical considerations. For example, if an investor wants to avoid investing in companies involved in tobacco or firearms, they may not be able to do so with an index fund that tracks a broad market index. 3. Inability to outperform the market. Index funds are designed to match the performance of a specific market index, not to outperform it. While this can be an advantage for investors who believe in the efficient market hypothesis and prefer a passive investment approach, it can be a disadvantage for those who want to beat the market or generate higher returns. Active fund managers aim to outperform the market by selecting stocks they believe will outperform or by timing the market. While not all active managers are successful in beating the market, some do manage to outperform their benchmarks. In contrast, index funds are designed to deliver market returns, which means they will not outperform the market. 4. Limited ability to react to market changes. Index funds are passively managed, which means they do not actively react to market changes or adjust their holdings based on market conditions. This lack of active management can be a disadvantage during periods of market volatility or when there are significant changes in the economy or industry trends. Active fund managers have the ability to make adjustments to their portfolios based on their analysis of market conditions. They can increase or decrease exposure to certain sectors or asset classes to take advantage of opportunities or mitigate risks. In contrast, index funds are bound by the composition of the underlying index and cannot make such adjustments. 5. Potential for overexposure to overvalued stocks. Index funds are designed to replicate the performance of a specific index, which means they will hold stocks in proportion to their weight in the index. This can lead to overexposure to overvalued stocks or sectors that may be experiencing a bubble. During periods of market exuberance, certain stocks or sectors may become overvalued, driven by investor sentiment rather than fundamental factors. Index funds, by design, will continue to hold these overvalued stocks as long as they are part of the index. This lack of active management can expose investors to the risk of holding overvalued securities. 6. Impact of dividend reinvestment. Index funds typically reinvest dividends received from the underlying securities back into the fund. While this can be advantageous for long-term investors who benefit from the power of compounding, it can also have tax implications. When dividends are reinvested, investors may be subject to taxes on those dividends, even if they did not receive any cash. This can result in a tax liability for investors, especially in taxable accounts. It is important for investors to consider the tax implications of dividend reinvestment when investing in index funds. Conclusion. While index funds offer many advantages, such as low costs and broad market exposure, they also have their disadvantages. Limited scope of diversification, lack of flexibility and customization, inability to outperform the market, limited ability to react to market changes, potential overexposure to overvalued stocks, and the impact of dividend reinvestment are some of the key disadvantages investors should be aware of. It is important for investors to carefully consider their investment goals, risk tolerance, and preferences before deciding to invest in index funds. They should also evaluate whether the advantages of index funds outweigh the disadvantages and whether index funds align with their investment strategy and objectives. 1.4 Choosing the right index fund. When it comes to investing in index funds, one of the most important decisions you will make is choosing the right fund for your investment goals. With so many options available, it can be overwhelming to determine which index fund is the best fit for you. In this section, we will discuss some key factors to consider when selecting an index fund. 1. Investment objective. The first step in choosing the right index fund is to clearly define your investment objective. Are you looking for long-term growth, income generation, or a combination of both? Different index funds are designed to meet different investment objectives. For example, if you are seeking capital appreciation, you may consider an index fund that tracks a broad market index such as the S&P 500. On the other hand, if you are looking for income, you might consider a dividend-focused index fund. 2. Index selection. Once you have determined your investment objective, the next step is to select the appropriate index. Index funds are designed to track specific market indexes, such as the Dow Jones Industrial Average or the Nasdaq Composite. Each index represents a different segment of the market, so it is important to choose an index that aligns with your investment goals. Consider factors such as the index's composition, sector allocation, and historical performance when making your decision. 3. Expense ratio. Expense ratio is another crucial factor to consider when choosing an index fund. This ratio represents the annual fees charged by the fund, expressed as a percentage of the fund's assets. Lower expense ratios are generally more favorable for investors, as they can have a significant impact on long-term returns. Be sure to compare expense ratios among different index funds to find the most cost-effective option. 4. Tracking error. Tracking error is a measure of how closely an index fund's performance matches the performance of its underlying index. While index funds aim to replicate the returns of their respective indexes, there can be slight deviations due to factors such as transaction costs and sampling techniques. A lower tracking error indicates a more accurate replication of the index's performance. It is important to assess the tracking error of an index fund to ensure that it aligns with your expectations. 5. Fund size and liquidity. The size and liquidity of an index fund can also impact its performance and ease of trading. Larger funds tend to have lower expense ratios and better liquidity, which can result in lower trading costs and improved overall performance. Additionally, larger funds may have more resources to effectively manage the fund and track the index. Consider the size and liquidity of an index fund when making your selection. 6. Historical performance. While past performance is not indicative of future results, it can provide valuable insights into an index fund's track record. Analyze the historical performance of the fund over different time periods and compare it to the performance of its underlying index. Look for consistency and stability in returns, as well as how the fund has performed during different market conditions. However, it is important to remember that historical performance should not be the sole basis for decision-making. 7. Fund manager and reputation. The fund manager's expertise and reputation can play a significant role in the success of an index fund. Research the fund manager's experience, qualifications, and track record in managing index funds. Additionally, consider the reputation of the fund provider and their commitment to investor interests. A reputable fund manager and provider can instill confidence and trust in your investment decision. 8. Investment minimums and account accessibility. Lastly, consider the investment minimums and account accessibility requirements of the index fund. Some funds may have minimum investment thresholds that you need to meet, while others may offer more flexibility. Additionally, consider whether the fund is available through your preferred investment platform or brokerage account. Accessibility and ease of investment are important factors to consider when choosing an index fund. In conclusion, choosing the right index fund requires careful consideration of your investment objectives, index selection, expense ratio, tracking error, fund size and liquidity, historical performance, fund manager reputation, and investment minimums. By evaluating these factors and conducting thorough research, you can make an informed decision that aligns with your investment goals and risk tolerance. Remember, index fund investing is a long-term strategy, so it is important to choose wisely and stay committed to your investment plan. 2. Understanding index fund performance. 2.1 Evaluating index fund returns. When it comes to evaluating the performance of index funds, one of the most important factors to consider is the fund's returns. Returns are a measure of how much an investment has gained or lost over a specific period of time. For index fund investors, understanding and evaluating these returns is crucial in making informed investment decisions. Understanding index fund returns. Index fund returns are typically reported as the percentage change in the fund's net asset value, NAV, over a specific time period. The NAV represents the total value of the fund's assets minus its liabilities, divided by the number of shares outstanding. It is important to note that index fund returns are based on the performance of the underlying index that the fund tracks. There are two main types of returns that investors should be familiar with: total returns and annualized returns. Total returns reflect the overall performance of the fund over a specific time period, including both capital appreciation and any dividends or distributions received. Annualized returns, on the other hand, provide an average annual return over a specific period, which can be useful for comparing the performance of different funds over different time frames. Evaluating index fund returns. When evaluating index fund returns, it is important to consider several factors to gain a comprehensive understanding of the fund's performance. 1. Time period. The time period over which returns are measured can significantly impact the interpretation of performance. Short-term returns may be more volatile and subject to market fluctuations, while long-term returns can provide a more stable and reliable measure of performance. It is important to consider both short-term and long-term returns to assess the fund's consistency and ability to deliver returns over time. 2. Benchmark comparison. Comparing the index fund's returns to its benchmark index is essential in evaluating its performance. The benchmark index represents the market segment or asset class that the fund aims to replicate. By comparing the fund's returns to its benchmark, investors can assess whether the fund is outperforming or underperforming its intended market. It is important to note that index funds are designed to closely track their benchmark, so any significant deviation may indicate a potential issue. 3. Risk-adjusted returns. Evaluating index fund returns in isolation may not provide a complete picture of the fund's performance. It is crucial to consider risk-adjusted returns, which take into account the level of risk taken to achieve those returns. One commonly used measure of risk-adjusted returns is the Sharpe ratio, which considers both the fund's returns and its volatility. A higher Sharpe ratio indicates better risk-adjusted performance. 4. Consistency of returns. Consistency of returns is an important factor to consider when evaluating index funds. Investors should assess whether the fund has consistently delivered positive returns over time or if it has experienced significant fluctuations. Consistency can be an indicator of the fund's ability to weather market downturns and provide stable returns over the long term. 5. Expense ratios. Expense ratios represent the annual fees charged by the fund for managing and operating expenses. These fees are deducted from the fund's assets, which can impact its returns. When evaluating index fund returns, it is important to consider the impact of expense ratios on the fund's overall performance. Lower expense ratios generally translate to higher net returns for investors. Limitations of evaluating index fund returns. While evaluating index fund returns is an important aspect of investment analysis, it is essential to recognize its limitations. Returns alone do not provide a complete picture of a fund's performance. Other factors, such as the fund's investment strategy, portfolio composition, and management team, should also be considered. Additionally, past performance is not indicative of future results. Just because a fund has delivered strong returns in the past does not guarantee similar performance in the future. Investors should conduct thorough research and consider multiple factors before making investment decisions. In conclusion, evaluating index fund returns is a critical step in assessing the performance of these investment vehicles. By considering factors such as time period, benchmark comparison, risk-adjusted returns, consistency, and expense ratios, investors can gain a better understanding of a fund's performance and make informed investment decisions. However, it is important to remember that returns alone should not be the sole basis for investment decisions, and a comprehensive analysis of the fund's overall characteristics is necessary. 2.2 Measuring index fund risk. When it comes to investing in index funds, understanding and managing risk is crucial. While index funds are generally considered to be lower risk compared to actively managed funds, they are not completely risk-free. In this section, we will explore the various ways to measure and assess the risk associated with index fund investments. Standard deviation. One of the most commonly used measures of risk is standard deviation. It provides an indication of how much the returns of an index fund have deviated from its average return over a specific period. A higher standard deviation implies greater volatility and higher risk. Investors can use standard deviation to compare the risk levels of different index funds. For example, if Fund A has a standard deviation of 10% and Fund B has a standard deviation of 15%, it suggests that Fund B is riskier than Fund A. However, it's important to note that standard deviation alone does not provide a complete picture of risk. Beta. Beta is another measure of risk that is commonly used in the investment world. It measures the sensitivity of an index fund's returns to changes in the overall market. A beta of 1 indicates that the fund's returns move in line with the market, while a beta greater than 1 suggests that the fund is more volatile than the market. On the other hand, a beta less than 1 indicates that the fund is less volatile than the market. Investors can use beta to assess how closely an index fund's returns track the performance of its underlying index. A higher beta implies that the fund's returns are likely to be more volatile than the index, while a lower beta suggests that the fund's returns are expected to be less volatile. Sharpe ratio. The Sharpe ratio is a risk-adjusted measure that takes into account both the return and the risk of an investment. It is calculated by subtracting the risk-free rate of return from the fund's return and dividing the result by the fund's standard deviation. The higher the Sharpe ratio, the better the risk-adjusted performance of the fund. The Sharpe ratio helps investors evaluate whether the returns generated by an index fund are commensurate with the level of risk taken. It allows for a more meaningful comparison between funds with different levels of risk. A higher Sharpe ratio indicates that the fund has generated higher returns for each unit of risk taken. Maximum drawdown. Maximum drawdown measures the largest percentage decline in the value of an index fund from its peak to its subsequent trough. It provides investors with an understanding of the potential loss they could have experienced during a specific period. A larger maximum drawdown indicates higher risk. Investors can use maximum drawdown to assess the downside risk of an index fund. It helps them understand the historical worst-case scenario and evaluate whether they are comfortable with the potential losses associated with the fund. Tracking error. Tracking error measures the consistency of an index fund's returns compared to its benchmark index. It quantifies the extent to which the fund's returns deviate from the returns of the index it aims to replicate. A higher tracking error suggests that the fund's returns are less closely aligned with the index. Investors should pay attention to tracking error as it indicates the level of risk associated with the fund's ability to replicate the performance of its benchmark. A higher tracking error may be a result of factors such as transaction costs, management fees, and imperfect replication of the index. Other considerations. While the measures mentioned above provide valuable insights into the risk associated with index funds, it's important to consider other factors as well. These include the fund's investment strategy, the composition of its underlying index, and the overall market conditions. Investors should also assess their own risk tolerance and investment goals before making any investment decisions. It's crucial to align the risk level of the chosen index fund with one's individual risk appetite and investment objectives. In conclusion, measuring index fund risk involves considering various factors such as standard deviation, beta, Sharpe ratio, maximum drawdown, and tracking error. These measures provide investors with a comprehensive understanding of the risk associated with index fund investments. By carefully evaluating and managing risk, investors can make informed decisions and build a well-diversified portfolio that aligns with their investment goals and risk tolerance. 2.3 Tracking error and index fund performance. When it comes to investing in index funds, one of the key factors to consider is the fund's performance. While index funds are designed to closely track the performance of a specific market index, there can be slight variations between the fund's returns and the index it aims to replicate. This variation is known as tracking error. Understanding tracking error. Tracking error is a measure of how closely an index fund's returns align with the returns of its underlying index. It represents the divergence between the fund's performance and the index it tracks. Tracking error is typically expressed as a percentage and can be positive or negative. A low tracking error indicates that the index fund closely mirrors the performance of its benchmark index, while a high tracking error suggests a greater deviation from the index's returns. It's important to note that tracking error is not necessarily an indication of poor performance. In some cases, a fund may intentionally deviate from the index to achieve specific investment objectives. Factors affecting tracking error. Several factors can contribute to tracking error in index funds. These include management fees. Index funds charge management fees to cover operating expenses. These fees can impact the fund's returns and contribute to tracking error. Generally, lower-cost index funds tend to have lower tracking error. Rebalancing. Index funds periodically rebalance their portfolios to maintain alignment with the underlying index. However, the timing and frequency of rebalancing can introduce tracking error. Funds that rebalance less frequently may have higher tracking error. Sampling. Some index funds use a sampling strategy instead of holding all the securities in the index. This can lead to tracking error if the sampled securities do not perfectly represent the index's composition. Dividends and expenses. The treatment of dividends and expenses can also impact tracking error. If an index fund reinvests dividends differently from the index or charges higher expenses, it can result in tracking error. Market conditions. Market volatility and liquidity can affect the ability of index funds to perfectly replicate the index's returns. During periods of high market volatility or when trading volumes are low, tracking error may increase. Evaluating tracking error. When evaluating index funds, it's essential to consider their tracking error. A low tracking error indicates that the fund closely tracks its benchmark index, which can be desirable for investors seeking to replicate the index's performance. However, it's important to assess tracking error in the context of the fund's investment objectives and strategy. For example, some actively managed index funds may intentionally deviate from the index to enhance returns or reduce risk. In such cases, a higher tracking error may be acceptable if it aligns with the fund's stated objectives. On the other hand, if an index fund aims to replicate the index precisely, a low tracking error is preferable. Investors should also compare the tracking error of an index fund with similar funds in the same asset class. This allows for a more accurate assessment of the fund's performance relative to its peers. Additionally, tracking error should be evaluated over multiple time periods to determine its consistency. Impact on investment returns. Tracking error can have implications for an investor's overall returns. A higher tracking error means that the fund's performance may deviate significantly from the index it aims to replicate. This can result in either outperformance or underperformance relative to the index. If an index fund consistently underperforms its benchmark index due to tracking error, investors may experience lower returns than expected. Conversely, if the fund consistently outperforms the index, investors may benefit from higher returns. However, it's important to note that consistently outperforming the index is challenging, and any deviation from the index's returns introduces additional risk. Managing tracking error. Investors can take several steps to manage tracking error and ensure their index fund aligns with their investment objectives. Research and select the right fund. Before investing, thoroughly research index funds and compare their tracking error. Choose a fund that closely aligns with the index you want to replicate and has a history of low tracking error. Consider fund expenses. Higher management fees can contribute to tracking error. Look for index funds with low expense ratios to minimize the impact of fees on overall returns. Monitor performance. Regularly review the performance of your index fund, including tracking error, to ensure it remains in line with your expectations. If the fund consistently deviates from the index, consider reevaluating your investment strategy. Diversify. Diversifying your portfolio across multiple index funds can help mitigate the impact of tracking error. By investing in funds that track different indices, you reduce the risk associated with any single fund's tracking error. Rebalance is needed. Periodically rebalance your portfolio to maintain your desired asset allocation. This helps ensure that any tracking error is minimized and your investment strategy remains on track. Conclusion. Tracking error is an important consideration when investing in index funds. While it represents the divergence between a fund's performance and its underlying index, it is not necessarily an indication of poor performance. Investors should evaluate tracking error in the context of the fund's investment objectives and strategy. By selecting the right fund, monitoring performance, and diversifying their portfolio, investors can effectively manage tracking error and align their index fund investments with their long-term goals. 2.4 Benchmarking index funds. Benchmarking is an essential aspect of evaluating the performance of index funds. It involves comparing the returns of an index fund to a specific benchmark index to determine how well the fund has performed relative to its intended market. By benchmarking index funds, investors can gain insights into the fund's ability to replicate the performance of the underlying index and assess its overall effectiveness. Understanding benchmark indices. A benchmark index serves as a reference point for measuring the performance of an index fund. It represents a specific market or sector and is typically composed of a basket of securities that reflect the characteristics of that market. Common benchmark indices include the S&P 500, Dow Jones Industrial Average, and Nasdaq Composite. When selecting an index fund, it is crucial to choose one that closely tracks its benchmark index. The fund's objective is to replicate the performance of the index it tracks, so any significant deviation from the benchmark may indicate a lack of effectiveness in achieving this goal. Evaluating index fund performance. To evaluate the performance of an index fund, investors need to compare its returns to the returns of the benchmark index over a specific period. This comparison allows investors to assess the fund's ability to deliver similar returns to the index it tracks. One commonly used metric for evaluating index fund performance is the tracking error. Tracking error measures the extent to which the fund's returns deviate from the benchmark index. A lower tracking error indicates a higher level of accuracy in replicating the index's performance. However, it is important to note that tracking error alone does not provide a complete picture of an index fund's performance. Other factors, such as expenses, fund management, and trading costs, can also impact the fund's returns relative to the benchmark. Selecting an appropriate benchmark. Choosing the right benchmark for an index fund is crucial for accurate performance evaluation. The benchmark should closely align with the fund's investment objective and asset class. For example, if an index fund focuses on large-cap U.S. stocks, the appropriate benchmark would be an index that represents the performance of large-cap U.S. stocks, such as the S&P 500. Using an inappropriate benchmark can lead to misleading performance comparisons. For instance, comparing the returns of an international index fund to a domestic benchmark would not provide an accurate assessment of the fund's performance. Importance of consistency in benchmarking. Consistency in benchmarking is essential to ensure accurate performance evaluation over time. It is crucial to use the same benchmark consistently when comparing the performance of an index fund. Changing the benchmark can distort the assessment of the fund's performance and make it challenging to track its progress accurately. Investors should also consider the longevity and stability of the benchmark index. A benchmark with a long history and a stable composition provides a more reliable basis for evaluating an index fund's performance. Limitations of benchmarking. While benchmarking is a valuable tool for evaluating index fund performance, it does have limitations. One limitation is that benchmark indices do not account for fees and expenses associated with investing in index funds. These costs can impact the fund's returns relative to the benchmark. Additionally, benchmarking does not consider the impact of taxes on investment returns. Taxes can significantly affect an investor's net returns, and it is important to consider the tax implications when evaluating the performance of an index fund. Furthermore, benchmarking does not provide insights into the future performance of an index fund. Past performance is not indicative of future results, and investors should exercise caution when solely relying on historical performance data. Conclusion. Benchmarking is a crucial aspect of evaluating the performance of index funds. By comparing the returns of an index fund to a specific benchmark index, investors can assess the fund's ability to replicate the performance of the underlying index. Selecting an appropriate benchmark and ensuring consistency in benchmarking are essential for accurate performance evaluation. However, it is important to recognize the limitations of benchmarking and consider other factors such as fees, taxes, and future performance expectations when making investment decisions. 3. Building a diversified index fund portfolio. 3.1 Asset allocation strategies. Asset allocation is a crucial aspect of building a successful index fund portfolio. It involves determining the appropriate mix of different asset classes within your portfolio to achieve your investment goals while managing risk. In this section, we will explore various asset allocation strategies that can help you optimize your index fund investments. The importance of asset allocation. Asset allocation is often considered the most critical factor in determining investment returns. Numerous studies have shown that asset allocation accounts for a significant portion of a portfolio's performance. In fact, it is estimated that asset allocation contributes to around 90% of a portfolio's variability in returns over time. The primary goal of asset allocation is to strike a balance between risk and reward. By diversifying your investments across different asset classes, you can potentially reduce the impact of market volatility on your portfolio. This diversification helps to smooth out the ups and downs of individual investments and can lead to more consistent long-term returns. Traditional asset allocation strategies. Strategic asset allocation. This approach involves setting a target allocation for each asset class based on your investment objectives, risk tolerance, and time horizon. The target allocation is typically rebalanced periodically to maintain the desired asset mix. Strategic asset allocation aims to provide a long-term investment strategy that aligns with your goals and risk tolerance. Tactical asset allocation. Unlike strategic asset allocation, tactical asset allocation involves making short-term adjustments to your portfolio based on market conditions. This strategy aims to take advantage of short-term market opportunities by overweighting or underweighting certain asset classes. Tactical asset allocation requires active monitoring of market trends and may involve more frequent portfolio adjustments. Core satellite asset allocation. This approach combines both passive index fund investments, the core, and actively managed funds or individual stocks, the satellites, within a portfolio. The core portion typically represents the majority of the portfolio and provides broad market exposure through low-cost index funds. The satellite portion allows for more targeted investments in specific sectors or regions, aiming to enhance returns or provide additional diversification. Modern portfolio theory and asset allocation. Modern portfolio theory, MPT, is a widely accepted framework for asset allocation. Developed by Nobel laureate Harry Markowitz, MPT emphasizes the importance of diversification and the relationship between risk and return. MPT suggests that by combining assets with different risk and return characteristics, an investor can construct an efficient portfolio that maximizes returns for a given level of risk or minimizes risk for a given level of returns. This concept is represented by the efficient frontier, which illustrates the optimal combinations of assets that provide the highest expected return for a given level of risk. To implement MPT, investors typically use statistical tools such as mean variance analysis to determine the optimal asset allocation. This analysis considers historical returns, volatility, and correlations between different asset classes to identify the portfolio mix that offers the best risk-return trade-off. Factors to consider in asset allocation. When determining your asset allocation strategy, several factors should be taken into account. Investment goals. Your investment goals, such as capital appreciation, income generation, or wealth preservation, will influence your asset allocation decisions. For example, if you have a long-term investment horizon and are seeking growth, you may allocate a higher percentage of your portfolio to equities. Risk tolerance. Your risk tolerance reflects your ability and willingness to withstand fluctuations in the value of your investments. Generally, investors with a higher risk tolerance can allocate a larger portion of their portfolio to higher risk assets, such as stocks. Time horizon. Your time horizon refers to the length of time you expect to hold your investments. Longer time horizons allow for a more aggressive asset allocation strategy, as there is more time to recover from short-term market fluctuations. Diversification. Diversification is a key principle in asset allocation. By spreading your investments across different asset classes, sectors, and regions, you can reduce the impact of any single investment on your overall portfolio. Diversification helps to mitigate risk and potentially enhance returns. Market conditions. Market conditions and economic outlook can influence asset allocation decisions. For example, during periods of economic uncertainty, investors may allocate a larger portion of their portfolio to defensive assets, such as bonds or cash. Rebalancing your portfolio. Once you have established your initial asset allocation, it is essential to regularly review and rebalance your portfolio. Rebalancing involves adjusting your asset allocation back to its original target weights to maintain the desired risk-return profile. Market fluctuations can cause your portfolio to deviate from its target allocation. For example, if equities have performed well, they may represent a higher percentage of your portfolio than intended. Rebalancing ensures that you sell assets that have appreciated and buy assets that have underperformed, effectively, selling high, and buying low. Rebalancing can be done on a predetermined schedule, such as annually or semi-annually, or when your portfolio deviates significantly from the target allocation. It is important to note that rebalancing may have tax implications, particularly in taxable accounts, as it may trigger capital gains or losses. Conclusion. Asset allocation is a critical component of successful index fund investing. By diversifying your investments across different asset classes and employing appropriate asset allocation strategies, you can optimize your portfolio's risk-return profile. Consider your investment goals, risk tolerance, time horizon, and market conditions when determining your asset allocation strategy. Regularly review and rebalance your portfolio to maintain your desired asset mix and stay on track towards achieving your financial objectives. 3.2 Choosing the right index funds for your portfolio. When it comes to building a diversified index fund portfolio, one of the most crucial decisions you'll need to make is choosing the right index funds. With thousands of index funds available in the market, selecting the ones that align with your investment goals and risk tolerance can be a daunting task. In this section, we will explore some key factors to consider when choosing index funds for your portfolio. 1. Define your investment objectives. Before diving into the world of index funds, it's essential to define your investment objectives. Ask yourself what you hope to achieve with your investments. Are you looking for long-term growth, income generation, or a combination of both? Understanding your goals will help you narrow down the types of index funds that are most suitable for your portfolio. 2. Consider your risk tolerance. Every investor has a different risk tolerance, which refers to the amount of volatility or potential loss they are willing to accept in their investments. It's crucial to assess your risk tolerance before selecting index funds. If you have a higher risk tolerance and are comfortable with market fluctuations, you may opt for index funds that track more volatile asset classes, such as emerging markets or small-cap stocks. On the other hand, if you have a lower risk tolerance, you may prefer index funds that track more stable asset classes, such as large-cap stocks or investment-grade bonds. 3. Evaluate the index fund's tracking error. Tracking error is a measure of how closely an index fund's performance matches the performance of its underlying index. A lower tracking error indicates that the fund closely mirrors the index, while a higher tracking error suggests greater deviation. When choosing index funds, it's generally preferable to select funds with lower tracking errors, as they are more likely to deliver returns that closely align with the index they track. 4. Assess the fund's expense ratio. Expense ratio is another critical factor to consider when choosing index funds. It represents the annual fee charged by the fund for managing your investments. Since index funds aim to replicate the performance of an index rather than actively manage investments, they typically have lower expense ratios compared to actively managed funds. However, it's still important to compare expense ratios among different index funds to ensure you're getting the best value for your money. Lower expense ratios can significantly impact your long-term returns. 5. Analyze the fund's historical performance. While past performance is not a guarantee of future results, analyzing a fund's historical performance can provide valuable insights. Look for index funds that have consistently tracked their respective indexes over the long term and have delivered competitive returns compared to their peers. However, it's important to remember that no fund can outperform its underlying index consistently, so be cautious of funds that claim to do so. 6. Consider the fund's asset size and liquidity. The size and liquidity of an index fund can also impact its performance and ability to track its underlying index effectively. Larger funds generally have more assets under management, which can enhance their ability to replicate the index accurately. Additionally, funds with higher liquidity are more likely to have tighter bid-ask spreads, making it easier to buy or sell shares without incurring significant transaction costs. 7. Diversify across asset classes and sectors. Diversification is a fundamental principle of investing, and it applies to index fund investing as well. Consider diversifying your portfolio by selecting index funds that track different asset classes, such as stocks, bonds, and real estate investment trusts REITs. Within each asset class, you can further diversify by choosing funds that track different sectors or industries. This diversification can help reduce the overall risk of your portfolio and increase the potential for long-term growth. 8. Review the fund's investment philosophy and methodology. Each index fund follows a specific investment philosophy and methodology. Some funds may use a market cap-weighted approach, where the weight of each holding is determined by its market capitalization. Others may use alternative weighting methods, such as equal-weighted or fundamentally weighted approaches. It's important to understand the fund's investment philosophy and methodology to ensure it aligns with your own investment beliefs. 9. Seek professional advice if needed. Choosing the right index funds for your portfolio can be a complex process, especially if you're new to investing. If you're unsure about which funds to select or need assistance in constructing a well-diversified portfolio, consider seeking advice from a financial advisor or investment professional. They can provide personalized guidance based on your individual circumstances and help you make informed decisions. Remember, building a diversified index fund portfolio is a long-term endeavor. Regularly review and monitor your portfolio to ensure it remains aligned with your investment goals and risk tolerance. By carefully selecting the right index funds and maintaining a disciplined approach, you can position yourself for long-term success in index fund investing. 3.3 Rebalancing your index fund portfolio. Once you have built a diversified index fund portfolio, it is important to regularly review and rebalance your investments. Rebalancing involves adjusting the allocation of your portfolio back to its original target weights. This process ensures that your portfolio remains aligned with your investment goals and risk tolerance. Why is rebalancing important? Over time, the performance of different asset classes within your portfolio can vary. Some investments may outperform while others may underperform. As a result, the original allocation of your portfolio can become skewed, leading to a higher concentration in certain assets. Rebalancing helps to maintain the desired level of diversification and manage risk. By periodically selling assets that have performed well and buying assets that have underperformed, you are essentially selling high and buying low. This disciplined approach allows you to take profits from investments that have done well and reinvest them in assets that have the potential for future growth. How often should you rebalance? The frequency of rebalancing depends on your investment strategy and personal preferences. Some investors prefer to rebalance on a set schedule, such as annually or semi-annually. Others choose to rebalance when their portfolio deviates from the target allocation by a certain percentage, typically around 5%. It is important to strike a balance between rebalancing too frequently and not rebalancing enough. Rebalancing too frequently can result in unnecessary transaction costs and potentially hinder long-term performance. On the other hand, not rebalancing enough can lead to a portfolio that is significantly out of alignment with your investment goals. How to rebalance your portfolio. There are several methods you can use to rebalance your index fund portfolio. Percentage-based rebalancing. This method involves setting target percentages for each asset class in your portfolio. When the actual allocation deviates from the target by a certain percentage, you rebalance by buying or selling assets to bring the allocation back in line with the target. Threshold-based rebalancing. With this approach, you set a threshold for each asset class. When the allocation of an asset class deviates from its target by the specified threshold, you rebalance by buying or selling assets. Time-based rebalancing. This method involves rebalancing on a set schedule, such as annually or semi-annually, regardless of the deviation from the target allocation. This approach provides a disciplined approach to rebalancing and removes the need for constant monitoring. Hybrid rebalancing. You can also combine different methods to suit your preferences. For example, you can use a time-based approach for rebalancing annually and then use a threshold-based approach to rebalance if any asset class deviates from its target by a certain percentage. Considerations for rebalancing. When rebalancing your index fund portfolio, there are a few important considerations to keep in mind. Transaction costs. Rebalancing involves buying and selling assets, which can result in transaction costs. It is important to consider the impact of these costs on your overall investment returns. Look for low-cost index funds and brokerage accounts that offer commission-free trades to minimize transaction costs. Tax implications. Rebalancing can trigger capital gains taxes if you sell investments that have appreciated in value. Consider the tax consequences of rebalancing and consult with a tax professional if needed. Additionally, you may want to prioritize tax-efficient funds in taxable accounts to minimize the tax impact of rebalancing. Maintaining diversification. While rebalancing helps maintain diversification, it is also an opportunity to reassess your investment strategy. Consider whether your target asset allocation is still aligned with your investment goals and risk tolerance. If necessary, make adjustments to your target allocation to ensure it reflects your current financial situation and objectives. Staying disciplined. Rebalancing requires discipline and a long-term perspective. It can be tempting to chase recent performance or make emotional decisions based on short-term market fluctuations. Stick to your rebalancing strategy and avoid making impulsive changes to your portfolio. Conclusion. Rebalancing is an essential part of managing your index fund portfolio. It helps maintain diversification, manage risk, and align your investments with your long-term goals. By establishing a rebalancing strategy that suits your investment style and regularly reviewing your portfolio, you can ensure that your index fund investments remain on track for success. Remember to consider transaction costs, tax implications, and the importance of staying disciplined throughout the rebalancing process. 3.4 Tax efficiency in index fund investing. Tax efficiency is an important consideration for investors, and it plays a significant role in the overall performance of an investment portfolio. When it comes to index fund investing, understanding the tax implications can help investors maximize their after-tax returns and minimize their tax liabilities. The tax advantage of index funds. One of the key advantages of index funds is their inherent tax efficiency. This is primarily due to their passive management style, which results in lower portfolio turnover compared to actively managed funds. Portfolio turnover refers to the buying and selling of securities within a fund, and it can trigger taxable events such as capital gains distributions. Since index funds aim to replicate the performance of a specific market index, they typically have lower turnover because they only need to make adjustments when the index itself changes. This means that index funds generally generate fewer capital gains and, as a result, distribute fewer taxable gains to their investors. Capital gains distributions. Capital gains distributions occur when a fund sells securities at a profit and distributes those gains to its shareholders. These distributions are subject to capital gains taxes, which can erode an investor's returns. However, due to their low turnover, index funds tend to have fewer capital gains distributions compared to actively managed funds. Furthermore, index funds are structured in a way that allows them to minimize the tax impact of any capital gains they do generate. They achieve this by using a buy and hold strategy, where they hold onto securities for the long term rather than frequently buying and selling. This approach helps defer capital gains taxes until the investor decides to sell their shares. Tax efficiency through tax loss harvesting. Another tax-efficient strategy employed by some index fund managers is tax loss harvesting. This strategy involves selling securities that have experienced losses to offset capital gains and reduce taxable income. The proceeds from the sale are then reinvested in a similar security to maintain the desired market exposure. Tax loss harvesting can be particularly beneficial for investors in high tax brackets as it allows them to offset capital gains and potentially reduce their overall tax liability. However, it's important to note that tax loss harvesting should be done strategically and with careful consideration of the investor's individual tax situation. Dividend tax efficiency. Dividends are another aspect of index fund investing that can have tax implications. Dividends are typically distributed by companies to their shareholders, and they are subject to dividend taxes. However, index funds, especially those that track broad-based market indexes, tend to have lower dividend yields compared to actively managed funds that focus on high dividend-paying stocks. This lower dividend yield can result in lower taxable income for investors in index funds. Additionally, some index funds employ strategies to minimize the tax impact of dividends, such as reinvesting them automatically or using tax-efficient dividend reinvestment plans. Tax-advantaged accounts in index fund investing. Investors can further enhance the tax efficiency of their index fund investments by utilizing tax-advantaged accounts such as individual retirement accounts, IRAs, and 401k plans. These accounts offer tax benefits that can help investors defer taxes or potentially eliminate them altogether. Contributions to traditional IRAs and 401k plans are typically made with pre-tax dollars, meaning that the investor's taxable income is reduced by the amount contributed. This allows the investments within these accounts to grow tax-deferred until withdrawals are made in retirement. Roth IRAs and Roth 401k plans, on the other hand, offer tax-free withdrawals in retirement, as contributions are made with after-tax dollars. By investing in index funds within these tax-advantaged accounts, investors can benefit from the tax efficiency of index funds while also taking advantage of the tax benefits offered by these accounts. This combination can significantly enhance an investor's after-tax returns over the long term. Conclusion. Tax efficiency is an important consideration for index fund investors. The passive management style of index funds, along with their low turnover and tax-efficient strategies such as tax loss harvesting, make them inherently tax-efficient investment vehicles. Additionally, the use of tax-advantaged accounts can further enhance the tax efficiency of index fund investments. By understanding the tax implications of index fund investing and implementing tax-efficient strategies, investors can maximize their after-tax returns and minimize their tax liabilities. It is always recommended to consult with a tax professional or financial advisor to develop a tax-efficient investment strategy that aligns with individual goals and circumstances. 3.5 International Index Funds. International index funds are a type of investment vehicle that allows investors to gain exposure to a diversified portfolio of stocks from companies located outside their home country. These funds track the performance of a specific international stock market index, such as the MSCI Europe, Australasia, and Far East or the FTSE Developed X North America Index. By investing in international index funds, investors can diversify their portfolios and potentially benefit from the growth and performance of global markets. Why invest in international index funds? There are several reasons why investors may choose to include international index funds in their investment portfolios. Diversification. Investing in international index funds provides diversification benefits by spreading investment across different countries and regions. This diversification can help reduce the risk associated with investing in a single country or region, as the performance of international markets may not always move in sync with domestic markets. Access to global markets. International index funds allow investors to participate in the growth and performance of global markets. By investing in international companies, investors can gain exposure to industries and sectors that may not be well represented in their home country. Currency exposure. Investing in international index funds can provide exposure to different currencies. This can be beneficial for investors looking to diversify their currency risk or take advantage of potential currency fluctuations. Opportunities for growth. International markets may offer unique investment opportunities and potential for growth that may not be available in domestic markets. By investing in international index funds, investors can tap into these opportunities and potentially enhance their overall investment returns. Types of international index funds. There are different types of international index funds that investors can consider, depending on their investment goals and risk tolerance. Some common types include broad market international index funds. These funds track the performance of a broad international stock market index, such as the MSCI All Country World X USA Index. They provide exposure to a wide range of companies across multiple countries and regions. Regional international index funds. These funds focus on specific regions, such as Europe, Asia, or emerging markets. They track regional stock market indices and provide investors with targeted exposure to companies within those regions. Country-specific international index funds. These funds concentrate on a single country's stock market. They track the performance of a specific country's stock market index, such as the FTSE Japan Index or the FTSE China Index. Investors interested in a particular country's market can use these funds to gain exposure. Sector-specific international index funds. These funds focus on specific sectors or industries within international markets. For example, there are international index funds that track the performance of technology companies or healthcare companies outside the investor's home country. Considerations for investing in international index funds. Before investing in international index funds, it is important to consider the following factors. Risk and volatility. International markets can be more volatile than domestic markets due to factors such as political instability, economic conditions, and currency fluctuations. Investors should be prepared for potential fluctuations in the value of their investments. Currency risk. Investing in international index funds exposes investors to currency risk. Changes in exchange rates can impact the value of investments denominated in foreign currencies. Investors should be aware of this risk and consider their risk tolerance and investment objectives. Market research and analysis. Investing in international index funds requires understanding the specific markets and regions in which the fund invests. Investors should conduct thorough research and analysis to evaluate the economic and political conditions, regulatory environment, and potential risks and opportunities of the target markets. Expense ratios and fees. Like any investment, international index funds have expense ratios and fees that can impact overall returns. Investors should compare expense ratios and fees across different funds to ensure they are getting the best value for their investment. Tax implications. Investing in international index funds may have tax implications, including potential withholding taxes on dividends and capital gains. Investors should consult with a tax advisor to understand the tax implications of investing in international index funds. Conclusion. International index funds offer investors the opportunity to diversify their portfolios and gain exposure to global markets. By investing in these funds, investors can potentially benefit from the growth and performance of international markets, access unique investment opportunities, and manage currency risk. However, it is important for investors to carefully consider the risks, conduct thorough research, and evaluate the fees and tax implications before investing in international index funds. 3.6 Sector and Industry Index Funds. Sector and industry index funds are a specific type of index fund that focuses on a particular sector or industry of the economy. While traditional index funds provide broad market exposure, sector and industry index funds allow investors to target specific areas of the market that they believe will outperform the overall market. Understanding sector and industry index funds. Sector and industry index funds are designed to track the performance of a specific sector or industry index. These indexes are created by selecting a group of companies that operate within a particular sector or industry. The index fund then invests in these companies in proportion to their weight in the index. For example, a sector index fund may track the performance of the technology sector, while an industry index fund may focus on the pharmaceutical industry. By investing in these funds, investors can gain exposure to the performance of a specific sector or industry without having to select individual stocks. Benefits of sector and industry index funds. Focused exposure. Sector and industry index funds allow investors to concentrate their investments in specific sectors or industries that they believe will perform well. This targeted exposure can be beneficial for investors who have a strong conviction about the prospects of a particular sector or industry. Diversification. While sector and industry index funds provide focused exposure, they still offer diversification within the chosen sector or industry. By investing in a fund that tracks a broad sector or industry index, investors can gain exposure to a variety of companies within that sector or industry. This diversification helps to reduce the risk associated with investing in individual stocks. Simplicity. Investing in sector and industry index funds is relatively straightforward. Investors can gain exposure to a specific sector or industry without the need to research and select individual stocks. This simplicity makes sector and industry index funds an attractive option for investors who prefer a passive investment approach. Liquidity. Sector and industry index funds are typically highly liquid, meaning that investors can easily buy or sell shares of the fund on the open market. This liquidity provides flexibility for investors to adjust their exposure to specific sectors or industries as market conditions change. Risks of sector and industry index funds. Concentration risk. Investing in sector and industry index funds exposes investors to concentration risk. If the chosen sector or industry underperforms, the value of the fund may decline significantly. It is important for investors to carefully consider their risk tolerance and diversify their portfolio across different sectors and industries to mitigate this risk. Market volatility. Sector and industry index funds can be more volatile than broad market index funds. This is because the performance of a specific sector or industry is influenced by factors that are unique to that sector or industry. Investors should be prepared for increased price fluctuations when investing in sector and industry index funds. Limited exposure. While sector and industry index funds provide targeted exposure to specific sectors or industries, they may not capture the full range of investment opportunities available in the market. By focusing on a particular sector or industry, investors may miss out on potential returns from other sectors or industries that are performing well. Incorporating sector and industry index funds in your portfolio. When considering sector and industry index funds for your portfolio, it is important to keep the following points in mind. Diversification. While sector and industry index funds can provide focused exposure, it is crucial to maintain a diversified portfolio. Investing solely in sector and industry index funds can increase the risk of your portfolio. Consider allocating a portion of your portfolio to sector and industry index funds while also including broad market index funds for overall diversification. Research and analysis. Before investing in a sector or industry index fund, conduct thorough research and analysis of the sector or industry you are considering. Understand the factors that drive the performance of that sector or industry and evaluate its long-term prospects. This will help you make informed investment decisions. Regular monitoring. Keep a close eye on the performance of the sector or industry index fund you have invested in. Monitor any changes in market conditions or trends that may impact the performance of the fund. Regularly review your portfolio and make adjustments as necessary to maintain your desired asset allocation. Consider your investment goals. Sector and industry index funds can be a valuable addition to your portfolio if they align with your investment goals and risk tolerance. Consider whether the potential benefits of investing in a specific sector or industry outweigh the risks and fit within your overall investment strategy. In conclusion, sector and industry index funds offer investors the opportunity to target specific sectors or industries within the market. While they provide focused exposure and potential benefits, it is important to carefully consider the risks and incorporate them into a well-diversified portfolio. By understanding the characteristics and potential of sector and industry index funds, investors can make informed decisions to achieve their investment goals. 4. Index fund investing for retirement. 4.1 Index funds and retirement planning. Retirement planning is a crucial aspect of financial management that requires careful consideration and strategic decision-making. One of the most effective tools for retirement planning is investing in index funds. Index funds offer a range of benefits that make them an ideal choice for individuals looking to secure their financial future during retirement. The power of index funds. Index funds are a type of mutual fund or exchange-traded fund (ETF) that aims to replicate the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. Unlike actively managed funds, which rely on the expertise of fund managers to select and trade individual stocks, index funds passively track the performance of an index. The primary advantage of index funds lies in their low-cost structure. Since they do not require active management, index funds have significantly lower expense ratios compared to actively managed funds. This means that more of your investment returns stay in your pocket, allowing your retirement savings to grow more efficiently over time. Diversification and risk mitigation. One of the key principles of successful retirement planning is diversification. By spreading your investments across different asset classes, you can reduce the impact of market volatility and minimize the risk of losing a significant portion of your retirement savings. Index funds offer a simple and effective way to achieve diversification. Index funds typically hold a broad range of securities that make up the underlying index. For example, an S&P 500 index fund would hold shares of the 500 largest publicly traded companies in the United States. By investing in an index fund, you gain exposure to a diversified portfolio of stocks, bonds, or other assets, depending on the index being tracked. Diversification helps to mitigate risk because it reduces the impact of any single investment on your overall portfolio. If one company or sector experiences a downturn, the performance of the other holdings in the index fund can help offset the losses. This can be particularly beneficial during retirement when preserving capital becomes a priority. Long-term growth potential. Retirement planning is a long-term endeavor, and index funds are well suited for this purpose. Over the long term, the stock market has historically delivered positive returns, and index funds allow you to participate in this growth. By investing in a broad-based index fund, you can capture the overall performance of the market, rather than relying on the success of individual stocks or sectors. Index funds provide exposure to a wide range of companies, which helps to reduce the impact of any single stock's performance on your portfolio. This diversification, combined with the long-term growth potential of the stock market, can help your retirement savings grow steadily over time. Cost-effective retirement investing. Another advantage of index funds for retirement planning is their cost-effectiveness. As mentioned earlier, index funds have lower expense ratios compared to actively managed funds. This is because index funds do not require the same level of research, analysis, and trading as actively managed funds. Lower expenses mean that more of your investment returns are working for you rather than being eaten up by fees. Over the course of many years, even a small difference in expense ratios can have a significant impact on your retirement savings. By choosing low-cost index funds, you can maximize your investment returns and potentially accumulate a larger nest egg for retirement. Automatic rebalancing and target date funds. Retirement planning often involves maintaining a balanced portfolio that aligns with your risk tolerance and investment goals. Index funds offer a convenient feature called automatic rebalancing, which helps you maintain your desired asset allocation over time. Automatic rebalancing ensures that your portfolio remains in line with your target allocation by periodically buying or selling assets within the index fund. For example, if your target allocation is 60% stocks and 40% bonds, and the stock market experiences significant gains, the automatic rebalancing feature will sell some stocks and buy more bonds to bring your portfolio back to the desired allocation. Target date funds are a specific type of index fund designed for retirement planning. These funds automatically adjust their asset allocation over time based on your expected retirement date. As you approach retirement, the target date fund gradually shifts from a more aggressive allocation to a more conservative one, reducing the risk as you near your retirement date. Tax efficiency in retirement. Tax efficiency is an important consideration when planning for retirement. The tax treatment of investments can have a significant impact on your overall returns. Index funds are known for their tax efficiency, which can help you maximize your after-tax returns during retirement. Index funds typically have lower turnover compared to actively managed funds. This means that they buy and sell securities less frequently, resulting in fewer taxable events. Additionally, index funds are structured in a way that allows investors to defer capital gains taxes until they sell their shares. This can be advantageous for retirement planning, as it allows your investments to grow tax-free until you start withdrawing funds during retirement. Conclusion. Index funds offer a compelling investment option for retirement planning. Their low-cost structure, diversification benefits, long-term growth potential, and tax efficiency make them an attractive choice for individuals looking to secure their financial future. By incorporating index funds into your retirement portfolio, you can build a solid foundation for a comfortable and financially secure retirement. 4.2 Target Date Index Funds. Target date index funds are a popular investment option for individuals planning for retirement. These funds are designed to automatically adjust their asset allocation over time, becoming more conservative as the target retirement date approaches. They offer a convenient and hands-off approach to retirement investing, making them an attractive choice for many investors. What are target date index funds? Target date index funds, also known as life cycle funds or retirement date funds, are a type of mutual fund that automatically adjusts its asset allocation based on the investor's target retirement date. The fund's asset allocation is typically a mix of stocks, bonds, and cash equivalents, with the allocation becoming more conservative as the target date approaches. The fund's name usually includes the target retirement year, such as Target Date 2050 Fund. The target date is typically chosen based on the investor's expected retirement year. For example, if an investor plans to retire in 2050, they would choose a target date fund with a target retirement year of 2050. How do target date index funds work? Target date index funds work by gradually shifting the asset allocation over time. In the early years, when retirement is far off, the fund will have a higher allocation to stocks, which tend to offer higher growth potential but also come with higher volatility. As the target retirement date approaches, the fund will gradually shift towards a more conservative allocation, with a higher percentage allocated to bonds and cash equivalents. The asset allocation adjustments are typically done automatically by the fund manager. This allows investors to have a hands-off approach to their retirement investments, as the fund manager takes care of the necessary adjustments. It is important to note that not all target date funds are index funds. Some target date funds are actively managed, meaning the fund manager actively selects and manages the underlying investments. Advantages of target date index funds. Target date index funds offer several advantages for retirement investors. Simplicity. Target date index funds provide a simple and convenient way to invest for retirement. Investors only need to choose the fund with the target retirement year that aligns with their goals, and the fund will automatically adjust its asset allocation over time. Diversification. Target date index funds typically hold a diversified mix of stocks, bonds, and cash equivalents. This diversification helps to spread the investment risk across different asset classes, reducing the impact of any single investment's performance on the overall portfolio. Cost effectiveness. Index funds are known for their low fees compared to actively managed funds. Target date index funds, which are passively managed, tend to have lower expense ratios compared to actively managed target date funds. Lower fees can have a significant impact on long-term investment returns. Consistent performance. Target date index funds aim to replicate the performance of a specific index, such as a broad stock market index or a bond index. By closely tracking the index, these funds seek to provide consistent and predictable returns over the long term. Automatic rebalancing. Target date index funds automatically rebalance the portfolio over time. This means that as the market fluctuates and the asset allocation drifts from the target, the fund manager will adjust the holdings to bring them back in line with the desired allocation. This helps to maintain the intended risk profile of the fund. Considerations for investing in target date index funds. While target date index funds offer many benefits, there are a few considerations to keep in mind. Limited customization. Target date index funds have a predetermined asset allocation based on the target retirement date. This means that investors have limited control over the specific mix of stocks, bonds, and cash equivalents in the fund. If you have specific investment preferences or goals, a different investment approach may be more suitable. One-size-fits-all approach. Target date index funds are designed to be a one-size-fits-all solution for retirement investing. While this can be convenient, it may not align perfectly with an individual's unique financial situation, risk tolerance, or investment goals. It's important to consider your personal circumstances before investing in a target date fund. Market volatility. Like any investment, target date index funds are subject to market volatility. During periods of market downturns, the value of the fund may decline. It's important to have a long-term perspective and be prepared for short-term fluctuations in value. Monitoring and adjustments. While target date index funds are designed to be hands-off investments, it's still important to periodically review your investment strategy and make adjustments as needed. Changes in personal circumstances, risk tolerance, or investment goals may warrant a reassessment of your target date fund. Conclusion. Target date index funds offer a convenient and straightforward approach to retirement investing. By automatically adjusting the asset allocation over time, these funds aim to provide a suitable investment strategy for individuals planning for retirement. While they may not be the perfect fit for everyone, target date index funds can be a valuable tool for long-term investors seeking a hands-off approach to retirement planning. As with any investment decision, it's important to carefully consider your individual circumstances and consult with a financial advisor if needed. 4.3 Index funds in 401k plans. Index funds have gained significant popularity among investors due to their low costs, diversification benefits, and consistent performance. One area where index funds have become particularly prevalent is within 401k retirement plans. In this section, we will explore the advantages of including index funds in your 401k plan and provide guidance on how to make the most of these investment vehicles. The benefits of index funds in 401k plans. Cost effectiveness. One of the primary advantages of index funds in 401k plans is their low expense ratios. Traditional actively managed funds often charge higher fees, which can eat into your investment returns over time. Index funds, on the other hand, aim to replicate the performance of a specific market index, resulting in lower management fees. By choosing index funds within your 401k plan, you can minimize costs and potentially increase your long-term returns. Diversification. Another key benefit of index funds is their inherent diversification. These funds typically hold a broad range of securities that mirror a specific index, such as the S&P 500 or the total stock market index. By investing in index funds within your 401k plan, you gain exposure to a wide variety of stocks or bonds, reducing the risk associated with individual security selection. Diversification helps to spread risk and can enhance the stability of your portfolio over time. Consistent performance. Index funds aim to replicate the performance of a specific market index, rather than trying to outperform it. While this may seem like a disadvantage compared to actively managed funds, research has consistently shown that the majority of actively managed funds fail to beat their respective benchmarks over the long term. By investing in index funds within your 401k plan, you can benefit from the consistent performance of the overall market, rather than relying on the unpredictable performance of individual fund managers. Simplicity. Index funds are designed to be straightforward and easy to understand. This simplicity makes them an excellent choice for investors who prefer a hands-off approach to their 401k investments. With index funds, you don't need to worry about analyzing individual stocks or making frequent investment decisions. Instead, you can focus on your long-term retirement goals while letting the index fund do the work of tracking the market. Choosing index funds for your 401k plan. When selecting index funds for your 401k plan, it's essential to consider a few key factors. Expense ratios. Compare the expense ratios of different index funds available in your 401k plan. Lower expense ratios mean more of your investment returns will stay in your pocket rather than being paid out in fees. Look for index funds with expense ratios that are significantly lower than the average for their asset class. Asset class coverage. Ensure that the index funds available in your 401k plan cover a broad range of asset classes. Ideally, you should have access to index funds that represent domestic and international stocks, bonds, and potentially other asset classes like real estate or commodities. Diversifying across different asset classes can help reduce risk and increase the potential for long-term growth. Tracking error. Consider the tracking error of the index funds you are evaluating. Tracking error measures how closely the fund's performance matches the performance of its underlying index. Lower tracking error indicates a more accurate replication of the index's returns. Look for index funds with consistently low tracking error to ensure they closely track their respective benchmarks. Fund size and liquidity. Evaluate the size and liquidity of the index funds you are considering. Larger funds tend to have lower expense ratios due to economies of scale. Additionally, higher liquidity ensures that you can easily buy or sell shares of the fund without significant price impact. Look for index funds with substantial assets under management and high trading volumes. Maximizing your 401k plan with index funds. To make the most of index funds within your 401k plan, consider the following strategies. Asset allocation. Determine your desired asset allocation based on your risk tolerance and investment goals. Allocate your 401k contributions across different index funds to achieve a diversified portfolio that aligns with your investment strategy. Remember to periodically rebalance your portfolio to maintain your desired asset allocation. Automatic contributions. Take advantage of automatic contributions to your 401k plan. By setting up regular contributions from your paycheck, you can benefit from dollar cost averaging, which involves buying more shares when prices are low and fewer shares when prices are high. This strategy can help smooth out market volatility and potentially enhance your long-term returns. Employer matching. If your employer offers a matching contribution to your 401k plan, ensure that you contribute enough to maximize the matching benefit. Employer matching is essentially free money and can significantly boost your retirement savings. Consider allocating these contributions to index funds to take advantage of their low costs and broad market exposure. Rebalancing. Regularly review and rebalance your 401k portfolio to maintain your desired asset allocation. Rebalancing involves selling overweighted assets and buying underweighted assets to bring your portfolio back in line with your target allocation. This disciplined approach ensures that you are not taking on excessive risk or missing out on potential returns. Tax efficiency. Index funds are known for their tax efficiency due to their low turnover and focus on long-term investing. However, it's still essential to consider the tax implications of your 401k investments. If possible, allocate tax-inefficient assets, such as bond funds, to your tax-advantaged accounts like traditional IRAs or 401k plans. This strategy can help minimize the tax impact on your overall investment returns. By incorporating index funds into your 401k plan and implementing these strategies, you can build a well-diversified, cost-effective, and tax-efficient retirement portfolio. Remember to regularly review your investment choices and adjust your allocations as needed to stay on track towards your retirement goals. 4.4 Index funds and IRA investing. Individual retirement accounts (IRAs) are a popular investment vehicle for individuals looking to save for retirement. These accounts offer tax advantages that can help investors grow their savings over time. Index funds, with their low costs and broad market exposure, are an excellent option for IRA investing. In this section, we will explore the benefits of investing in index funds within an IRA and provide some tips for maximizing your retirement savings. Why invest in index funds within an IRA? Tax advantages. One of the primary benefits of investing in an IRA is the potential for tax-deferred or tax-free growth. Traditional IRAs allow you to contribute pre-tax dollars, reducing your taxable income in the year of contribution. This means that any gains within the IRA are not subject to immediate taxation. Roth IRAs, on the other hand, allow for tax-free growth, as contributions are made with after-tax dollars. Both types of IRAs can be used to invest in index funds, allowing you to take advantage of their long-term growth potential without incurring immediate tax liabilities. Diversification. Index funds provide instant diversification by investing in a broad range of securities that make up a specific market index. By investing in index funds within your IRA, you can further diversify your retirement portfolio. Diversification helps reduce the risk associated with investing in individual stocks or sectors, as losses in one area can be offset by gains in others. This can help protect your retirement savings from market volatility and increase the likelihood of long-term growth. Low costs. Index funds are known for their low expense ratios compared to actively managed funds. This is because index funds aim to replicate the performance of a specific market index rather than relying on active management. By investing in low-cost index funds within your IRA, you can minimize the impact of fees on your overall returns. Over time, even small differences in expense ratios can have a significant impact on your retirement savings. Consistent performance. Index funds have a track record of delivering consistent performance over the long term. While they may not outperform the market in every period, they tend to provide competitive returns over time. By investing in index funds within your IRA, you can benefit from this consistent performance and potentially grow your retirement savings at a steady pace. Tips for maximizing your IRA investments in index funds. Determine your risk tolerance. Before investing in index funds within your IRA, it's essential to assess your risk tolerance. Consider your investment goals, time horizon, and comfort level with market fluctuations. Index funds offer exposure to the overall market, which can be subject to volatility. Understanding your risk tolerance will help you select the appropriate index funds for your IRA portfolio. Choose a diversified mix of index funds. To maximize the benefits of index fund investing within your IRA, consider diversifying your portfolio across different asset classes and market sectors. This can help spread your risk and capture potential growth opportunities. For example, you may include index funds that track domestic stocks, international stocks, bonds, and real estate investment trusts REITs. By diversifying your holdings, you can reduce the impact of any single investment on your overall portfolio. Rebalance periodically. As with any investment portfolio, it's important to periodically rebalance your IRA holdings to maintain your desired asset allocation. Rebalancing involves selling investments that have performed well and buying more of those that have underperformed. This helps ensure that your portfolio remains aligned with your long-term goals and risk tolerance. Rebalancing can be done annually or semi-annually, depending on your preferences and market conditions. Consider target date index funds. Target date index funds are designed to automatically adjust their asset allocation based on your expected retirement date. These funds gradually shift from a more aggressive allocation to a more conservative one as you approach retirement. Target date index funds can be an excellent option for individuals who prefer a hands-off approach to managing their IRA investments. They provide instant diversification and automatic rebalancing, making them a convenient choice for retirement savings. Consult with a financial advisor. If you're unsure about how to best invest in index funds within your IRA, consider consulting with a financial advisor. An advisor can help you assess your financial goals, risk tolerance, and time horizon to develop a personalized investment strategy. They can also provide guidance on selecting the most suitable index funds for your IRA and help you navigate any tax implications. In conclusion, investing in index funds within an IRA can be a smart strategy for building a retirement nest egg. The tax advantages, diversification, low costs, and consistent performance of index funds make them an attractive option for long-term investors. By following the tips outlined in this section and staying committed to your retirement savings goals, you can make the most of your IRA investments in index funds and increase your chances of achieving a comfortable retirement. 5. Index fund strategies for wealth accumulation. 5.1 Long-term investing with index funds. When it comes to long-term investing, index funds have proven to be a reliable and effective strategy for many investors. These funds offer a passive approach to investing, aiming to replicate the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. In this section, we will explore the benefits and considerations of long-term investing with index funds. The power of compounding. One of the key advantages of long-term investing with index funds is the power of compounding. Compounding refers to the ability of an investment to generate earnings, which are then reinvested to generate even more earnings. Over time, this compounding effect can significantly boost your investment returns. Index funds are well suited for long-term investing because they provide broad market exposure and have low expense ratios. By investing in a diversified portfolio of stocks or bonds through an index fund, you can capture the overall growth of the market over the long term. This allows you to benefit from the compounding effect as your investment grows. Consistency and stability. Another advantage of long-term investing with index funds is the consistency and stability they offer. Unlike actively managed funds, which rely on the skills and decisions of fund managers, index funds simply aim to replicate the performance of a specific index. This passive approach eliminates the need for constant monitoring and adjustments, providing a more stable investment experience. Index funds also tend to have lower turnover rates compared to actively managed funds. This means that they buy and sell securities less frequently, resulting in lower transaction costs and potentially lower capital gains taxes. By minimizing these costs, index funds can help maximize your long-term investment returns. Diversification and risk reduction. Diversification is a fundamental principle of investing, and index funds excel in providing broad market exposure. By investing in an index fund, you gain exposure to a wide range of securities within a specific market or asset class. This diversification helps reduce the risk associated with investing in individual stocks or bonds. For example, if you were to invest in a single stock, your investment returns would be heavily dependent on the performance of that particular company. However, by investing in an index fund that tracks a market index, you spread your risk across multiple companies. This diversification helps mitigate the impact of any individual company's poor performance on your overall investment. Cost effectiveness. Cost effectiveness is another significant advantage of long-term investing with index funds. Index funds typically have lower expense ratios compared to actively managed funds. The expense ratio represents the annual fee charged by the fund to cover operating expenses. Since index funds aim to replicate the performance of an index rather than actively manage a portfolio, their expenses tend to be lower. Lower expense ratios translate into higher net returns for investors. Over the long term, even a small difference in expense ratios can have a significant impact on your investment returns. By choosing index funds with low expense ratios, you can keep more of your investment earnings and potentially achieve higher long-term growth. Patience and discipline. Long-term investing with index funds requires patience and discipline. It is essential to have a long-term perspective and resist the temptation to make frequent changes to your investment strategy based on short-term market fluctuations. Index funds are designed to capture the overall market performance over time, and trying to time the market can be challenging and often counterproductive. Instead, focus on your long-term investment goals and stick to your investment plan. Regularly review your portfolio to ensure it remains aligned with your objectives, but avoid making impulsive decisions based on short-term market movements. By maintaining a disciplined approach, you can benefit from the long-term growth potential of index funds. Conclusion. Long-term investing with index funds offers several advantages, including the power of compounding, consistency and stability, diversification, cost-effectiveness, and the need for patience and discipline. By harnessing these benefits, investors can build a solid foundation for their long-term financial goals. Remember, investing in index funds is not a guarantee of future returns, and it is essential to conduct thorough research and consider your risk tolerance before making any investment decisions. However, for many investors, index funds provide a straightforward and effective way to participate in the long-term growth of the market while minimizing costs and risks. 5.2 Cost averaging with index funds. Dollar cost averaging is a popular investment strategy that can be effectively used with index funds. It involves investing a fixed amount of money at regular intervals, regardless of the current price of the fund. This approach allows investors to take advantage of market fluctuations by buying more shares when prices are low and fewer shares when prices are high. Dollar cost averaging can help reduce the impact of market volatility and potentially enhance long-term returns. How dollar cost averaging works. The concept of dollar cost averaging is simple. Instead of trying to time the market and make large lump sum investments, investors commit to investing a fixed amount of money at regular intervals, such as monthly or quarterly. This approach ensures that investors buy more shares when prices are low and fewer shares when prices are high. For example, let's say you decide to invest $500 in an index fund every month. If the price of the fund is $50 per share, you would buy 10 shares. However, if the price increases to $60 per share, your $500 would only buy 8.33 shares. Conversely, if the price decreases to $40 per share, your $500 would buy 12.5 shares. Over time, this strategy allows you to accumulate more shares when prices are low, potentially leading to a lower average cost per share. Benefits of dollar cost averaging with index funds. Dollar cost averaging offers several benefits when used with index funds. Reduced risk. By investing a fixed amount regularly, you reduce the risk of making large investments at the wrong time. This strategy helps smooth out the impact of market volatility and reduces the risk of making emotional investment decisions based on short-term market fluctuations. Disciplined approach. Dollar cost averaging enforces a disciplined approach to investing. It encourages investors to stick to their investment plan and avoid making impulsive decisions based on market conditions. This approach is particularly beneficial for long-term investors who are focused on accumulating wealth over time. Automatic investing. Dollar cost averaging can be easily automated through regular contributions to your investment account. This automation eliminates the need for constant monitoring and decision-making, making it a convenient strategy for busy investors. Potential for lower average cost. By consistently investing over time, dollar cost averaging allows you to buy more shares when prices are low. This can potentially lower your average cost per share and increase your overall returns when the market eventually recovers. Mitigating market timing risk. Timing the market is notoriously difficult, even for experienced investors. Dollar cost averaging eliminates the need to predict market movements and removes the risk of making poor investment decisions based on short-term market fluctuations. Considerations for dollar cost averaging with index funds. While dollar cost averaging can be an effective strategy, it's important to consider a few factors when implementing it with index funds. Investment horizon. Dollar cost averaging works best when you have a long-term investment horizon. It allows you to benefit from the compounding effect of returns over time. If you have a short-term investment goal, such as saving for a down payment on a house in the next year, dollar cost averaging may not be the most suitable strategy. Fund selection. Choose index funds that align with your investment goals and risk tolerance. Consider factors such as the fund's expense ratio, tracking error, and historical performance. Diversifying your investments across different asset classes and geographic regions can also help reduce risk. Regular contributions. Consistency is key when implementing dollar cost averaging. Set up automatic contributions to your investment account to ensure you stick to your investment plan. Regularly review your contributions to ensure they align with your financial goals and adjust them as necessary. Monitoring and rebalancing. While dollar cost averaging is a passive investment strategy, it's important to periodically review your portfolio and rebalance if necessary. Over time, the performance of different asset classes may vary, causing your portfolio to deviate from your desired asset allocation. Rebalancing ensures that your portfolio remains aligned with your long-term investment objectives. Conclusion. Dollar cost averaging is a powerful strategy that can be effectively used with index funds. By investing a fixed amount regularly, regardless of market conditions, investors can reduce risk, maintain discipline, and potentially enhance long-term returns. However, it's important to consider your investment horizon, fund selection, regular contributions, and monitoring and rebalancing when implementing this strategy. Dollar cost averaging, when combined with the benefits of index fund investing, can be a valuable tool for wealth accumulation over time. 5.3 Leveraged and inverse index funds. Leveraged and inverse index funds are specialized types of index funds that offer investors the opportunity to amplify their returns or profit from market declines. These funds are designed for more experienced and sophisticated investors who are willing to take on higher levels of risk in pursuit of potentially higher rewards. Understanding leveraged index funds. Leveraged index funds, also known as leveraged ETFs, exchange-traded funds, aim to provide a multiple of the daily returns of an underlying index. For example, a 2x leveraged index fund seeks to deliver twice the daily return of its benchmark index. These funds use financial derivatives and borrowing to achieve their leveraged exposure. The appeal of leveraged index funds lies in their potential for magnified gains. If the underlying index experiences a positive return, the leveraged fund can generate double or triple the return, depending on the level of leverage. This can be attractive to investors who have a bullish outlook on the market and want to amplify their potential profits. However, it's important to note that leveraged index funds are designed to deliver their stated multiple of the daily return over a single trading day. Due to compounding effects, the long-term performance of these funds may deviate significantly from the multiple of the index's return. As a result, leveraged index funds are generally not suitable for long-term buy-and-hold strategies. Risks of leveraged index funds. While leveraged index funds offer the potential for higher returns, they also come with increased risks. The use of leverage magnifies both gains and losses, which means that if the underlying index experiences a decline, the leveraged fund will suffer a more significant loss. Additionally, leveraged index funds are subject to compounding effects, which can lead to a phenomenon known as volatility decay, or beta slippage. This occurs when the fund's daily returns do not perfectly align with the multiple of the index's return due to compounding over time. As a result, the long-term performance of leveraged index funds may not match the expectations of investors. Investors considering leveraged index funds should also be aware of the potential for increased costs. These funds often have higher expense ratios compared to traditional index funds due to the additional costs associated with leverage and derivatives. Inverse index funds. Inverse index funds, also known as short or bear ETFs, are designed to deliver the opposite performance of an underlying index. These funds aim to profit from declining markets by providing investors with a return that is inversely correlated to the index's performance. Inverse index funds achieve their inverse exposure through the use of derivatives, such as futures contracts or swaps. For example, a 1x inverse index fund seeks to deliver the opposite daily return of its benchmark index. If the index declines by 1%, the inverse fund should generate a 1% positive return. Similar to leveraged index funds, inverse index funds are designed to deliver their stated inverse return over a single trading day. Due to compounding effects, the long-term performance of these funds may deviate from the inverse of the index's return. Risks of inverse index funds. Investing in inverse index funds carries its own set of risks. While these funds can provide a hedge against market declines, they are not suitable for long-term buy-and-hold strategies. Over time, compounding effects can lead to a divergence between the fund's performance and the inverse of the index's return. Inverse index funds are also subject to the risks associated with derivatives and leverage. These funds may experience higher volatility and increased costs compared to traditional index funds. It's important to note that leveraged and inverse index funds are complex financial instruments that require a deep understanding of their mechanics and risks. They are not suitable for all investors and should only be considered by those who have a thorough understanding of the underlying strategies and are willing to accept the potential for significant losses. Before investing in leveraged or inverse index funds, it is crucial to carefully read the fund's prospectus and consult with a financial advisor who can provide guidance based on your individual investment goals, risk tolerance, and time horizon. In conclusion, leveraged and inverse index funds can be powerful tools for experienced investors looking to amplify their returns or profit from market declines. However, they come with increased risks and complexities that require careful consideration. It is essential to thoroughly understand these funds and their potential impact on your investment portfolio before making any investment decisions. 5.4 Index funds for college savings. Investing in index funds can be a smart strategy for college savings. With the rising costs of education, it is essential to start planning and saving early to ensure that you have enough funds to cover tuition, fees, and other expenses. Index funds offer several advantages that make them an attractive option for college savings. Why choose index funds for college savings? Diversification. Index funds provide instant diversification by investing in a broad range of securities that make up a specific market index, such as the S&P 500 or the total stock market index. This diversification helps reduce the risk associated with investing in individual stocks or sectors. Low costs. Index funds are known for their low expense ratios compared to actively managed funds. These lower costs can have a significant impact on your college savings over the long term, as fees can eat into your investment returns. By choosing index funds, you can keep more of your money working for you. Consistent performance. While index funds aim to replicate the performance of a specific market index, they have historically delivered competitive returns over the long term. By investing in a diversified portfolio of index funds, you can benefit from the overall growth of the market. Passive management. Index funds are passively managed, meaning they aim to match the performance of a specific index rather than trying to outperform it. This passive approach eliminates the need for constant monitoring and frequent trading, making it a convenient option for busy parents saving for their child's education. Choosing the right index funds for college savings. When selecting index funds for college savings, there are a few factors to consider. Time horizon. Determine how many years you have until your child starts college. The longer the time horizon, the more aggressive you can be with your investment choices. As college approaches, you may want to gradually shift your investments to more conservative options to protect your savings. Risk tolerance. Assess your risk tolerance and comfort level with market fluctuations. If you are more risk-averse, you may prefer a more conservative allocation with a higher percentage of bond index funds. If you can tolerate more volatility, a higher allocation to stock index funds may be appropriate. Asset allocation. Consider your desired asset allocation based on your time horizon and risk tolerance. A common approach is to have a mix of stock index funds, bond index funds, and possibly international index funds. This diversified portfolio can help balance risk and potential returns. Expense ratios. Compare the expense ratios of different index funds. Lower expense ratios mean more of your investment returns stay in your pocket. Look for index funds with expense ratios that are below the industry average. Fund performance. While past performance is not indicative of future results, it can provide insights into how a fund has performed relative to its benchmark index. Look for index funds that have consistently tracked their respective indexes and have a solid track record. College savings strategies with index funds. Once you have chosen the right index funds for your college savings, consider implementing the following strategies. Regular contributions. Set up automatic contributions to your index fund portfolio. Regularly investing a fixed amount each month or quarter can help you take advantage of dollar cost averaging, which can smooth out the impact of market fluctuations over time. Rebalancing. Periodically review and rebalance your index fund portfolio to maintain your desired asset allocation. As certain asset classes outperform or underperform, your portfolio's allocation may drift from your original plan. Rebalancing ensures that you stay on track with your investment strategy. 529 College Savings Plans. Consider utilizing a 529 College Savings Plan, which offers tax advantages for education savings. These plans allow you to invest in a variety of index funds and provide tax-free growth and withdrawals when used for qualified education expenses. Gradual shift to conservative investments. As your child approaches college age, gradually shift your investments to more conservative options, such as bond index funds or money market funds. This strategy helps protect your savings from potential market downturns when you need the funds for tuition payments. Maximize tax efficiency. Be mindful of the tax implications of your college savings. Consider holding index funds in tax-advantaged accounts like 529 plans or IRAs to minimize taxes on investment gains. Additionally, avoid unnecessary capital gains taxes by holding index funds for the long term. Conclusion. Investing in index funds for college savings can be a prudent strategy to grow your savings over time. By taking advantage of the benefits of index funds, such as diversification, low costs, and consistent performance, you can build a solid foundation for your child's education. Remember to choose the right index funds based on your time horizon, risk tolerance, and investment goals. Implementing college savings strategies, such as regular contributions, rebalancing, and utilizing tax-advantaged accounts, can further enhance your savings potential. Start early, stay disciplined, and watch your college savings grow with the power of index funds. 6. Index fund investing for income. 6.1 Dividend index funds. Dividend index funds are a type of index fund that focuses on investing in stocks that pay regular dividends. These funds are designed to provide investors with a steady stream of income through the dividends received from the underlying stocks in the fund. Dividend index funds are popular among income-focused investors who are looking for a reliable source of cash flow from their investments. How dividend index funds work. Dividend index funds work by tracking a specific dividend index, such as the Dividend Aristocrats or the Dividend Achievers Index. These indexes consist of stocks that have a history of consistently increasing their dividend payments over time. The funds aim to replicate the performance of these indexes by investing in the same stocks in the same proportions. When you invest in a dividend index fund, you become a shareholder in the fund, which in turn holds a diversified portfolio of dividend-paying stocks. As the underlying stocks in the fund pay dividends, the fund collects these dividends and distributes them to its shareholders on a regular basis. The frequency of dividend distributions can vary depending on the fund, but it is typically quarterly or annually. Benefits of dividend index funds. Steady income. Dividend index funds provide investors with a reliable source of income. The dividends received from the underlying stocks can be reinvested or used as cash flow to meet living expenses. Diversification. Dividend index funds offer investors exposure to a diversified portfolio of dividend-paying stocks. This diversification helps to reduce the risk associated with investing in individual stocks. Lower costs. Dividend index funds are typically passively managed, which means they have lower expense ratios compared to actively managed funds. This can result in higher net returns for investors over the long term. Tax efficiency. Dividend index funds can be tax efficient for investors. Qualified dividends received from stocks held in the fund may be eligible for lower tax rates, depending on the investor's tax bracket. Long-term growth potential. Dividend-paying stocks have historically outperformed non-dividend-paying stocks over the long term. By investing in dividend index funds, investors can benefit from the potential for both income and capital appreciation. Considerations for investing in dividend index funds. Risk. While dividend index funds can provide a steady income stream, they are not without risk. The underlying stocks in the fund can still experience price fluctuations, which can impact the fund's performance. It's important to assess the risk tolerance and investment objectives before investing in dividend index funds. Yield versus growth. Dividend index funds can be categorized into two types: high yield and dividend growth. High yield funds focus on stocks with higher dividend yields, while dividend growth funds prioritize stocks with a history of increasing dividends. Investors should consider their income needs and investment goals when choosing between these two types of funds. Expense ratios. While dividend index funds generally have lower expense ratios compared to actively managed funds, it's still important to compare the costs of different funds. Lower expense ratios can have a significant impact on long-term returns. Reinvestment options. Dividend index funds offer different reinvestment options for the dividends received. Some funds automatically reinvest the dividends back into the fund, while others allow investors to receive the dividends in cash. Consider your preference for reinvestment when selecting a dividend index fund. Conclusion. Dividend index funds can be a valuable addition to an investor's portfolio, especially for those seeking a reliable income stream. These funds provide exposure to a diversified portfolio of dividend-paying stocks, offering the potential for both income and long-term growth. However, it's important to carefully consider the risks, expenses, and investment objectives before investing in dividend index funds. By doing so, investors can make informed decisions and potentially benefit from the advantages these funds offer. 6.2 Bond Index Funds. Bond index funds are a type of index fund that focuses on investing in a diversified portfolio of bonds. These funds aim to replicate the performance of a specific bond index, such as the Barclays U.S. Aggregate Bond Index or the Bloomberg Barclays Global Aggregate Bond Index. Bond index funds provide investors with exposure to the fixed income market, allowing them to benefit from the income generated by bonds and potentially achieve capital appreciation. Understanding bond index funds. Bond index funds are designed to track the performance of a specific bond index by holding a portfolio of bonds that closely matches the index's composition. The underlying bonds in these funds can include government bonds, corporate bonds, municipal bonds, and other types of fixed income securities. The fund manager's goal is to replicate the index's performance by purchasing bonds in the same proportion as the index. One of the key advantages of bond index funds is their low-cost structure. Since these funds aim to replicate the performance of an index rather than actively manage a portfolio, they have lower management fees compared to actively managed bond funds. This cost advantage can be significant over the long term, especially when compounded over many years. Benefits of bond index funds. Diversification. Bond index funds provide investors with exposure to a wide range of bonds, which helps to diversify their investment portfolio. By investing in a variety of bonds, investors can reduce the risk associated with holding a single bond or a small number of bonds. Lower costs. Bond index funds typically have lower expense ratios compared to actively managed bond funds. This is because index funds aim to replicate the performance of an index rather than relying on active management strategies. Lower costs can lead to higher net returns for investors. Transparency. Bond index funds disclose their holdings on a regular basis, allowing investors to see exactly which bonds are included in the fund. This transparency provides investors with a clear understanding of the fund's composition and helps them make informed investment decisions. Stability. Bonds are generally considered less volatile than stocks, making bond index funds a more stable investment option. These funds can provide a steady stream of income through regular interest payments, which can be particularly attractive for investors seeking income or looking to balance the risk in their portfolio. Risks of bond index funds. Interest rate risk. bond prices and interest rates have an inverse relationship. When interest rates rise, bond prices tend to fall, and vice versa. Bond index funds are not immune to interest rate risk. If interest rates increase, the value of the underlying bonds in the fund may decline, leading to a decrease in the fund's net asset value (NAV). Credit risk. Bond index funds invest in a variety of bonds, including those issued by governments, corporations, and municipalities. Each bond carries its own credit risk, which refers to the likelihood of the issuer defaulting on its debt obligations. If a bond held by the fund defaults, it can negatively impact the fund's performance. Inflation risk. Inflation erodes the purchasing power of fixed income investments, including bonds. If the rate of inflation exceeds the yield generated by the bonds in the fund, investors may experience a decrease in real returns. Liquidity risk. Some bonds may have limited liquidity, meaning they may be difficult to buy or sell at a desired price. This can impact the fund's ability to efficiently manage its portfolio and may result in higher transaction costs. Considerations for investing in bond index funds. Investment horizon. Bond index funds are generally considered suitable for investors with a medium to long-term investment horizon. These funds are designed to provide a steady stream of income and may not be appropriate for short-term investment goals. Risk tolerance. Investors should assess their risk tolerance before investing in bond index funds. While these funds are generally less volatile than equity funds, they still carry risks, particularly interest rate risk and credit risk. Investors with a lower risk tolerance may prefer to allocate a smaller portion of their portfolio to bond index funds. Diversification. Bond index funds can be used as part of a diversified investment portfolio. By combining different asset classes, such as stocks, bonds, and cash, investors can potentially reduce the overall risk of their portfolio and achieve a more balanced investment strategy. Expense ratios. When comparing bond index funds, investors should consider the expense ratio, which represents the annual fees charged by the fund. Lower expense ratios can have a significant impact on long-term returns. Tax considerations. Bond index funds may generate taxable income through interest payments. Investors should be aware of the tax implications and consider holding bond index funds in tax-advantaged accounts, such as individual retirement accounts (IRAs) or 401k plans, to potentially minimize their tax liability. In conclusion, bond index funds offer investors a cost-effective and diversified way to gain exposure to the fixed income market. These funds can provide stability, income, and potential capital appreciation. However, investors should carefully consider the risks associated with bond investing and assess their investment goals and risk tolerance before investing in bond index funds. 6.3 Real Estate Index Funds. Real estate has long been considered a lucrative investment opportunity, providing investors with the potential for both income and capital appreciation. Traditionally, investing in real estate required significant capital and expertise in property management. However, with the advent of real estate index funds, individual investors now have the opportunity to gain exposure to the real estate market without the hassle of directly owning and managing properties. Real estate index funds are a type of exchange-traded fund (ETF) that tracks the performance of a specific real estate index. These funds invest in a diversified portfolio of real estate assets, such as residential, commercial, and industrial properties. By investing in real estate index funds, investors can gain exposure to the overall performance of the real estate market, without the need to select and manage individual properties. One of the key advantages of investing in real estate index funds is the diversification they offer. Real estate index funds typically hold a broad range of properties across different sectors and geographic locations. This diversification helps to reduce the risk associated with investing in a single property or a specific real estate market. By spreading their investments across multiple properties, investors can mitigate the impact of any individual property's performance on their overall portfolio. Another benefit of real estate index funds is the liquidity they provide. Unlike direct real estate investments, which can be illiquid and require significant time and effort to buy or sell, real estate index funds can be bought and sold on the stock exchange, just like any other publicly traded security. This liquidity allows investors to easily enter or exit their positions, providing them with flexibility and the ability to quickly adjust their real estate exposure based on market conditions or their investment goals. Real estate index funds also offer investors the advantage of professional management. These funds are typically managed by experienced real estate professionals who have in-depth knowledge of the market and can make informed investment decisions on behalf of the fund. This professional management can be particularly beneficial for individual investors who may not have the time, expertise, or resources to actively manage their own real estate investments. When considering investing in real estate index funds, it is important to understand the underlying index that the fund tracks. Different real estate indexes may have different methodologies and focus on specific sectors or geographic regions. Some indexes may be more heavily weighted towards residential properties, while others may have a greater emphasis on commercial or industrial properties. Investors should carefully evaluate the index composition and ensure that it aligns with their investment objectives and risk tolerance. It is also important to consider the fees associated with investing in real estate index funds. Like any other investment product, real estate index funds charge management fees and other expenses. These fees can vary among different funds, so investors should compare the costs and consider the impact on their overall investment returns. Additionally, investors should also be aware of any potential tax implications associated with investing in real estate index funds, such as capital gains taxes on the sale of fund shares. Real estate index funds can be a valuable addition to an investor's portfolio, providing exposure to the real estate market and diversification benefits. However, like any investment, it is important to carefully evaluate the risks and potential rewards before investing. Investors should consider their investment goals, risk tolerance, and time horizon when deciding whether to include real estate index funds in their portfolio. In conclusion, real estate index funds offer individual investors the opportunity to gain exposure to the real estate market without the need for direct property ownership. These funds provide diversification, liquidity, and professional management, making them an attractive option for investors looking to add real estate to their investment portfolio. However, investors should carefully evaluate the underlying index, fees, and potential tax implications before investing in real estate index funds. 6.4 Income Strategies with Index Funds. Investing in index funds can be a great way to generate income for investors. While index funds are primarily known for their ability to provide long-term growth and capital appreciation, they can also be utilized to generate income through various strategies. In this section, we will explore some income strategies that investors can employ when investing in index funds. Dividend index funds. One of the most common income strategies with index funds is investing in dividend index funds. Dividend index funds are designed to track the performance of a specific dividend index, which consists of stocks that pay regular dividends to their shareholders. These funds typically invest in companies with a history of stable and consistent dividend payments. Dividend index funds can be an attractive option for income-focused investors, as they provide a regular stream of income in the form of dividend payments. These funds distribute a portion of the dividends received from the underlying stocks to their investors on a periodic basis, usually quarterly or annually. The dividend income can be reinvested or taken as cash, depending on the investor's preference. Investing in dividend index funds offers several advantages. First, it provides a reliable and predictable income stream, which can be particularly beneficial for retirees or investors seeking passive income. Second, dividend index funds offer diversification, as they typically hold a basket of dividend-paying stocks across different sectors and industries. This diversification helps to mitigate the risk associated with investing in individual dividend stocks. Bond index funds. Another income strategy with index funds is investing in bond index funds. Bond index funds are designed to track the performance of a specific bond index, which consists of a portfolio of bonds issued by various entities such as governments, municipalities, and corporations. These funds aim to provide investors with exposure to a diversified portfolio of fixed income securities. Bond index funds generate income through the interest payments received from the underlying bonds. When an investor purchases shares of a bond index fund, they are essentially lending money to the issuers of the bonds in the fund's portfolio. In return, the issuers pay interest on the borrowed funds, which is then passed on to the investors as income. Investing in bond index funds can be an attractive income strategy for investors seeking stability and regular income. Bonds are generally considered less volatile than stocks, making bond index funds a relatively low-risk investment option. Additionally, bond index funds offer diversification across different types of bonds, maturities, and credit qualities, which helps to spread the risk associated with investing in individual bonds. Real estate index funds. Real estate index funds can also be utilized as an income strategy for investors. These funds are designed to track the performance of a specific real estate index, which consists of a portfolio of real estate investment trusts, REITs, or real estate-related companies. Real estate index funds provide investors with exposure to the real estate market without the need to directly own physical properties. Real estate index funds generate income through the rental income and dividends received from the underlying real estate investments. REITs, which are a common component of real estate index funds, were required by law to distribute a significant portion of their taxable income to shareholders in the form of dividends. This makes real estate index funds an attractive option for income-focused investors. Investing in real estate index funds offers several advantages. First, it provides investors with the opportunity to participate in the potential income and capital appreciation of the real estate market. Second, real estate index funds offer diversification across different types of real estate assets, such as residential, commercial, and industrial properties. This diversification helps to reduce the risk associated with investing in individual real estate properties. Combining income strategies. Investors can also combine different income strategies with index funds to create a diversified income portfolio. For example, an investor may choose to allocate a portion of their portfolio to dividend index funds, another portion to bond index funds, and a third portion to real estate index funds. This combination allows investors to benefit from multiple sources of income and diversify their risk across different asset classes. When combining income strategies, it is important for investors to consider their investment goals, risk tolerance, and time horizon. Each income strategy has its own characteristics and risk profile, and investors should carefully assess their suitability based on their individual circumstances. In conclusion, investing in index funds can be an effective way to generate income for investors. Dividend index funds, bond index funds, and real estate index funds are all viable options for income-focused investors. By combining different income strategies, investors can create a diversified income portfolio that aligns with their investment goals and risk tolerance. It is important for investors to conduct thorough research and seek professional advice before implementing any income strategy with index funds. 7. Index fund investing for tax efficiency. 7.1 Tax-efficient index fund strategies. When it comes to investing in index funds, tax efficiency is an important consideration for investors. Taxes can eat into your investment returns, so it's crucial to employ strategies that minimize the impact of taxes on your index fund investments. In this section, we will explore some tax-efficient index fund strategies that can help you maximize your after-tax returns. Understanding tax efficiency. Before diving into specific strategies, let's first understand what tax efficiency means in the context of index fund investing. Tax efficiency refers to the ability of an investment strategy to minimize the tax consequences associated with buying, holding, and selling investments. In other words, it's about maximizing your after-tax returns by minimizing the amount of taxes you owe. Holding index funds in tax-advantaged accounts. One of the most effective ways to achieve tax efficiency with index funds is to hold them in tax-advantaged accounts such as individual retirement accounts, IRAs, or 401k plans. These accounts offer tax advantages that can help you grow your investments more efficiently. Contributions to traditional IRAs and 401k plans are made with pre-tax dollars, which means you can deduct the contributions from your taxable income in the year you make them. This reduces your current tax liability and allows your investments to grow tax-deferred until you withdraw the funds in retirement. By holding your index funds in these accounts, you can defer taxes on any dividends or capital gains generated by your investments. Roth IRAs and Roth 401k plans, on the other hand, are funded with after-tax dollars. While you don't get an immediate tax deduction for contributions, qualified withdrawals from these accounts are tax-free. This means that any dividends or capital gains generated by your index funds held in a Roth account can be withdrawn tax-free in retirement. By strategically allocating your index funds between traditional and Roth accounts, you can create a tax-efficient withdrawal strategy in retirement. Minimizing portfolio turnover. Another key factor in tax-efficient index fund investing is minimizing portfolio turnover. Portfolio turnover refers to the frequency with which the fund buys and sells securities within its portfolio. When a fund sells securities at a profit, it generates capital gains, which are taxable. By minimizing portfolio turnover, you can reduce the amount of taxable capital gains generated by the fund. Index funds are known for their low turnover because they aim to replicate the performance of a specific index rather than actively trade securities. This inherent low turnover makes index funds naturally tax efficient compared to actively managed funds. However, even within the realm of index funds, some funds have lower turnover than others. Look for index funds with low expense ratios and low turnover to maximize tax efficiency. Tax loss harvesting. Tax loss harvesting is a strategy that involves selling investments that have experienced a loss to offset capital gains and reduce your tax liability. This strategy can be particularly useful in taxable accounts where you have realized capital gains from other investments. With index funds, tax loss harvesting can be challenging because they typically have low volatility and tend to generate long-term capital gains rather than short-term losses. However, if you have a diversified portfolio that includes other investments, you may be able to identify opportunities for tax loss harvesting by strategically rebalancing your portfolio. Asset location. Asset location refers to the practice of strategically placing different types of investments in different types of accounts to optimize tax efficiency. Generally, it's more tax efficient to hold investments that generate ordinary income, such as bonds or real estate investment trusts, REITs, in tax-advantaged accounts. On the other hand, investments that generate long-term capital gains, such as stocks or stock index funds, may be more suitable for taxable accounts. By carefully considering the tax implications of different investments and their location within your overall portfolio, you can minimize the amount of taxes you owe and maximize your after-tax returns. Conclusion. Tax efficiency is an important aspect of index fund investing. By employing tax-efficient strategies such as holding index funds in tax-advantaged accounts, minimizing portfolio turnover, utilizing tax loss harvesting, and optimizing asset location, you can minimize the impact of taxes on your index fund investments and maximize your after-tax returns. Remember to consult with a tax professional or financial advisor to determine the best tax-efficient strategies for your specific situation. 7.2 Tax loss harvesting with index funds. Tax loss harvesting is a strategy that can be employed by index fund investors to minimize their tax liabilities and potentially increase their after-tax returns. It involves strategically selling investments that have experienced a loss in order to offset capital gains and reduce taxable income. This technique is particularly beneficial for investors in taxable accounts who are looking to optimize their tax efficiency. How tax loss harvesting works. The concept behind tax loss harvesting is relatively straightforward. When an investment in an index fund experiences a loss, the investor can sell that investment and use the capital loss to offset any capital gains realized from other investments. If the capital losses exceed the capital gains, the excess losses can be used to offset ordinary income, up to a certain limit. For example, let's say you have invested in an index fund and over the course of the year, the value of your investment has declined. By selling the investment at a loss, you can use that loss to offset any capital gains you may have realized from other investments. If you have more losses than gains, you can use the excess losses to offset up to $3,000 of ordinary income. Any remaining losses can be carried forward to future years. Benefits of tax loss harvesting. The primary benefit of tax loss harvesting is the potential to reduce your tax liability. By strategically selling investments that have experienced losses, you can offset capital gains and potentially reduce the amount of taxes you owe. This can have a significant impact on your after-tax returns, especially over the long term. Another advantage of tax loss harvesting is that it allows you to maintain your desired asset allocation while still taking advantage of tax benefits. Instead of completely liquidating an investment that has experienced a loss, you can sell it and reinvest the proceeds in a similar index fund or a different fund that tracks a different index. This way, you can still participate in the market and maintain your desired level of diversification. Considerations for tax loss harvesting. While tax loss harvesting can be a valuable strategy, there are a few important considerations to keep in mind. Wash sale rule. The wash sale rule is a regulation that prevents investors from claiming a tax loss if they repurchase a substantially identical investment within 30 days of selling it at a loss. This means that if you sell an index fund at a loss, you cannot repurchase the same or a substantially identical fund within the 30-day period before or after the sale. If you do, the loss will be disallowed for tax purposes. Long-term capital gains. When implementing tax loss harvesting, it's important to be mindful of the potential impact on long-term capital gains. If you sell an investment that you have held for more than 1 year at a loss, it will be considered a long-term capital loss. Long-term capital losses can only be used to offset long-term capital gains, not ordinary income. Therefore, if you have significant long-term capital gains, tax loss harvesting may not provide as much benefit. Transaction costs. Executing tax loss harvesting strategies may involve transaction costs, such as brokerage fees or bid-ask spreads. These costs should be taken into consideration when evaluating the potential benefits of the strategy. It's important to weigh the potential tax savings against the costs associated with selling and reinvesting in different index funds. Implementing tax loss harvesting. To effectively implement tax loss harvesting with index funds, it's important to have a clear understanding of your investment holdings and their tax implications. Here are some steps to consider. Review your investment portfolio. Identify any investments that have experienced losses and determine their tax implications. Evaluate your capital gains. Assess your capital gains from other investments to determine the potential benefit of offsetting them with capital losses. Consider the wash sale rule. Be mindful of the wash sale rule and avoid repurchasing substantially identical investments within the 30-day period before or after selling them at a loss. Reinvest strategically. If you sell an investment at a loss, consider reinvesting the proceeds in a similar index fund or a different fund that aligns with your investment goals and maintains your desired asset allocation. Keep track of your tax losses. Maintain accurate records of your capital losses and consult with a tax professional to ensure you are maximizing the tax benefits of your strategy. Conclusion. Tax loss harvesting can be a valuable strategy for index fund investors looking to optimize their tax efficiency. By strategically selling investments that have experienced losses, investors can offset capital gains and potentially reduce their tax liabilities. However, it's important to be aware of the wash sale rule, consider the impact on long-term capital gains, and evaluate the transaction costs associated with implementing the strategy. With careful planning and consideration, tax loss harvesting can be an effective tool for enhancing after-tax returns in index fund investing. 7.3 Index funds and capital gains taxes. When it comes to investing in index funds, it's important to understand the potential impact of capital gains taxes on your investment returns. Capital gains taxes are taxes imposed on the profits you make from selling an investment, such as an index fund, that has increased in value since you bought it. In this section, we will explore how capital gains taxes work and how they can affect your index fund investments. How capital gains taxes work. Capital gains taxes are typically divided into two categories: short-term capital gains and long-term capital gains. The classification depends on how long you hold the investment before selling it. Short-term capital gains apply to investments that are held for 1 year or less. These gains are taxed at your ordinary income tax rate, which can be significantly higher than the tax rate for long-term capital gains. The exact tax rate you'll pay on short-term capital gains depends on your income level and tax bracket. Long-term capital gains, on the other hand, apply to investments that are held for more than 1 year. The tax rates for long-term capital gains are generally lower than those for short-term gains. The specific tax rates for long-term capital gains also depend on your income level and tax bracket. It's important to note that the tax rates for capital gains can change over time, as they are subject to legislation and government policies. Therefore, it's crucial to stay informed about any potential changes that may affect your tax liability. Index funds and capital gains taxes. Index funds, like any other investment, can generate capital gains when their underlying securities increase in value. These gains can occur when the index fund's holdings appreciate or when the fund manager buys and sells securities within the fund. When an index fund sells a security at a profit, it realizes a capital gain. This gain is then passed on to the fund's shareholders in the form of capital gains distributions. As a shareholder, you may be subject to capital gains taxes on these distributions, even if you didn't sell any of your shares. The frequency and magnitude of capital gains distributions can vary depending on the index fund's investment strategy and turnover rate. Index funds with low turnover rates tend to generate fewer capital gains distributions, which can be beneficial from a tax perspective. Minimizing capital gains taxes with index funds. While you cannot completely avoid capital gains taxes when investing in index funds, there are strategies you can employ to minimize their impact on your investment returns. Buy and hold strategy. One way to minimize capital gains taxes is to adopt a buy and hold strategy. By holding onto your index fund investments for the long term, you can qualify for the lower tax rates associated with long-term capital gains. This strategy allows you to defer taxes until you decide to sell your shares. Tax-efficient index funds. Another strategy is to invest in tax-efficient index funds. These funds are specifically designed to minimize capital gains distributions by employing strategies such as sampling the index or using in-kind transfers to manage the fund's holdings. By reducing the number of taxable events within the fund, tax-efficient index funds can help lower your tax liability. Tax loss harvesting. Tax loss harvesting is a strategy that involves selling investments that have experienced a loss to offset capital gains from other investments. By strategically selling losing positions, you can reduce your overall capital gains tax liability. However, it's important to be aware of the wash sale rule, which prohibits repurchasing the same or substantially identical investment within 30 days of selling it. Investing in tax-advantaged accounts. Another way to minimize capital gains taxes is to invest in tax-advantaged accounts such as individual retirement accounts, IRAs, or 401k plans. Contributions to these accounts are made with pre-tax dollars, and any capital gains within the account are tax-deferred until you withdraw the funds in retirement. By utilizing these accounts, you can potentially defer or eliminate capital gains taxes altogether. Conclusion. Capital gains taxes are an important consideration when investing in index funds. By understanding how these taxes work and implementing tax-efficient strategies, you can minimize their impact on your investment returns. Remember to consult with a tax professional or financial advisor to determine the best approach for your specific situation. 7.4 Tax-advantaged accounts and index fund investing. Investing in index funds can be a smart strategy for long-term wealth accumulation. However, it's important to consider the tax implications of your investments. One way to maximize your returns and minimize your tax liability is by utilizing tax-advantaged accounts. Tax-advantaged accounts, such as individual retirement accounts (IRAs) and employer-sponsored retirement plans like 401ks, offer significant tax benefits that can enhance the growth of your index fund investments. These accounts provide either tax-deferred or tax-free growth, allowing your investments to compound over time without the burden of annual taxes. The benefits of tax-advantaged accounts. There are several advantages to investing in index funds through tax-advantaged accounts. Tax-deferred growth. With traditional IRAs and 401ks, your contributions are made with pre-tax dollars, meaning you don't pay taxes on the money you invest until you withdraw it in retirement. This allows your investments to grow tax-deferred, potentially resulting in a larger nest egg over time. Tax-free growth. Roth IRAs and Roth 401ks offer tax-free growth. Although contributions to these accounts are made with after-tax dollars, qualified withdrawals in retirement are tax-free. This can be advantageous if you expect to be in a higher tax bracket in the future. Lower capital gains taxes. By investing in index funds within a tax-advantaged account, you can avoid or delay paying capital gains taxes on any profits you earn. This can be particularly beneficial if you have a high turnover rate within your index fund portfolio. No required minimum distributions (RMDs). Traditional IRAs and 401ks require you to start taking minimum distributions once you reach a certain age, usually 72. However, Roth IRAs do not have RMDs, allowing your investments to continue growing tax-free for as long as you like. Choosing the right tax-advantaged account. When it comes to investing in index funds through tax-advantaged accounts, you have several options to consider. Traditional IRA. This account allows you to contribute pre-tax dollars, reducing your taxable income for the year. However, withdrawals in retirement are taxed as ordinary income. Roth IRA. Contributions to a Roth IRA are made with after-tax dollars, but qualified withdrawals in retirement are tax-free. This can be advantageous if you expect your tax rate to be higher in the future. 401k or 403b plan. These employer-sponsored retirement plans often offer a selection of index funds to choose from. Contributions are made with pre-tax dollars, and taxes are deferred until withdrawal in retirement. Roth 401k or Roth 403b plan. Similar to a Roth IRA, contributions to these plans are made with after-tax dollars, but qualified withdrawals in retirement are tax-free. Maximizing tax efficiency in index fund investing. To maximize the tax efficiency of your index fund investments within tax-advantaged accounts, consider the following strategies. Asset location. Place tax-efficient index funds, such as those that track broad market indexes, in taxable accounts. Reserve tax inefficient funds, such as those that generate a lot of taxable income, for tax-advantaged accounts. Tax loss harvesting. Take advantage of market downturns by selling index funds that have experienced losses to offset capital gains in your portfolio. This can help reduce your overall tax liability. Rebalancing. Use your tax-advantaged accounts for rebalancing your portfolio. By selling and buying within these accounts, you can avoid triggering capital gains taxes. Avoid short-term trading. Short-term capital gains are taxed at higher rates than long-term gains. By holding your index fund investments for at least 1 year, you can qualify for the lower long-term capital gains tax rates. Conclusion. Investing in index funds through tax-advantaged accounts can provide significant tax benefits and enhance the growth of your investments. By utilizing tax-deferred or tax-free growth, you can potentially accumulate more wealth over time. Consider the various tax-advantaged account options available to you and implement strategies to maximize tax efficiency within your index fund portfolio. Remember to consult with a financial advisor or tax professional to ensure you make the most informed decisions based on your individual circumstances. 8. Index fund investing for socially responsible investors. 8.1 Understanding socially responsible investing. Socially responsible investing (SRI) is an investment strategy that aims to generate financial returns while also considering the social and environmental impact of the companies in which you invest. It is a way for investors to align their investment portfolios with their personal values and beliefs. SRI has gained significant popularity in recent years as more investors seek to make a positive impact with their investments. This approach allows individuals to support companies that are committed to sustainable practices, social justice, and ethical business conduct. One of the key principles of socially responsible investing is the consideration of environmental, social, and governance (ESG) factors. ESG factors encompass a wide range of issues, including climate change, human rights, labor standards, corporate governance, and diversity. By evaluating companies based on these factors, investors can identify those that are making positive contributions to society and the environment. There are several approaches to socially responsible investing. One common strategy is negative screening, where investors exclude companies involved in industries such as tobacco, weapons, or fossil fuels from their portfolios. This approach allows investors to avoid supporting companies that may have a negative impact on society or the environment. Another approach is positive screening, where investors actively seek out companies that are leaders in sustainability, renewable energy, or social impact. These companies are often at the forefront of innovation and are working towards a more sustainable future. By investing in these companies, investors can support their efforts and potentially benefit from their long-term growth. Socially responsible index funds are a popular investment option for those interested in SRI. These funds track a specific socially responsible index, which is composed of companies that meet certain ESG criteria. By investing in these funds, individuals can gain exposure to a diversified portfolio of socially responsible companies without the need for extensive research and analysis. One advantage of socially responsible index funds is their simplicity. They offer investors a convenient way to align their investments with their values without the need for active management. These funds typically have low fees and can be easily purchased through brokerage accounts or retirement plans. When evaluating socially responsible index funds, it is important to consider the specific ESG criteria used by the fund. Different funds may have varying approaches to defining and measuring sustainability and social impact. Some funds may focus on specific industries or issues, while others may have a broader scope. It is important to review the fund's prospectus and understand its investment strategy before making a decision. It is also worth noting that socially responsible index funds may have slightly different performance characteristics compared to traditional index funds. The exclusion or inclusion of certain companies based on ESG criteria can impact the fund's returns and risk profile. However, studies have shown that socially responsible investing does not necessarily result in lower returns. In fact, companies with strong ESG practices have been found to outperform their peers over the long term. Investing in socially responsible index funds can be a powerful way to make a positive impact while also achieving your financial goals. By supporting companies that are committed to sustainability and social responsibility, you can contribute to a more equitable and sustainable future. However, it is important to conduct thorough research and consider your own investment objectives before making any investment decisions. In conclusion, socially responsible investing offers investors the opportunity to align their investment portfolios with their personal values. Socially responsible index funds provide a convenient and cost-effective way to invest in companies that are making positive contributions to society and the environment. By considering ESG factors and evaluating the impact of your investments, you can create a portfolio that reflects your values while also pursuing financial returns. 8.2 Socially responsible index funds. Socially responsible investing (SRI) has gained significant popularity in recent years as investors increasingly seek to align their investment strategies with their personal values and beliefs. Socially responsible index funds provide a way for investors to incorporate environmental, social, and governance (ESG) factors into their investment portfolios while still benefiting from the diversification and low costs associated with index fund investing. What are socially responsible index funds? Socially responsible index funds, also known as sustainable index funds or ESG index funds, are investment vehicles that track a specific index composed of companies that meet certain environmental, social, and governance criteria. These funds aim to invest in companies that demonstrate responsible business practices, such as reducing carbon emissions, promoting workplace diversity, or maintaining strong corporate governance. Similar to traditional index funds, socially responsible index funds aim to replicate the performance of a specific index, such as the MSCI KLD 400 Social Index or the FTSE 4 Good Index. However, instead of simply tracking the broad market, these funds focus on companies that meet specific sustainability criteria. Advantages of socially responsible index funds. Alignment with values. Socially responsible index funds allow investors to align their investment portfolios with their personal values and beliefs. By investing in companies that prioritize sustainability and social responsibility, investors can support positive change and contribute to a more sustainable future. Diversification. Like traditional index funds, socially responsible index funds offer diversification benefits by investing in a broad range of companies across different sectors and industries. This diversification helps reduce the risk associated with investing in individual stocks. Lower costs. Socially responsible index funds typically have lower expense ratios compared to actively managed funds that focus on sustainable investing. This cost advantage is due to the passive nature of index fund investing, which aims to replicate the performance of a specific index rather than relying on active stock selection. Transparency. Socially responsible index funds often provide transparency regarding the specific ESG criteria used to select the companies included in the fund. This transparency allows investors to understand the underlying holdings and make informed decisions about their investments. Long-term performance. Studies have shown that companies with strong ESG practices can outperform their peers over the long term. By investing in socially responsible index funds, investors may benefit from the potential financial performance of companies that prioritize sustainability and responsible business practices. Considerations for investing in socially responsible index funds. Definition of socially responsible. Different socially responsible index funds may have varying criteria for selecting companies. It is important for investors to understand the specific ESG factors considered by the fund and ensure they align with their personal values. Performance trade-offs. While socially responsible index funds aim to deliver competitive returns, there may be instances where the fund's performance lags behind traditional index funds. This can be due to the exclusion of certain industries or companies that do not meet the fund's sustainability criteria. Investors should carefully evaluate the potential trade-offs between financial performance and social impact. Data quality and reporting. The availability and quality of ESG data can vary across companies and industries. Investors should consider the reliability and consistency of the data used by socially responsible index funds to assess the sustainability practices of the underlying companies. Active engagement. Some socially responsible index funds actively engage with the companies in their portfolios to encourage improved sustainability practices. Investors may want to consider whether the fund actively participates in shareholder advocacy and engagement activities. Diversification limitations. Socially responsible index funds may have a narrower investment universe compared to traditional index funds. This can result in a higher concentration of holdings in certain sectors or industries. Investors should ensure that the fund's diversification aligns with their risk tolerance and investment objectives. Conclusion. Socially responsible index funds provide investors with an opportunity to align their investment portfolios with their personal values and beliefs. These funds offer the benefits of diversification, low costs, and transparency while investing in companies that prioritize sustainability and social responsibility. However, investors should carefully evaluate the specific ESG criteria used by the fund, consider potential performance trade-offs, and assess the reliability of ESG data. By incorporating socially responsible index funds into their investment strategies, investors can contribute to positive change while pursuing their financial goals. 8.3 Evaluating the impact of socially responsible index funds. Socially responsible investing (SRI) has gained significant popularity in recent years as investors increasingly seek to align their investment strategies with their personal values and beliefs. This has led to the emergence of socially responsible index funds, which aim to provide investors with the opportunity to invest in companies that meet certain environmental, social, and governance (ESG) criteria. In this section, we will explore the impact of socially responsible index funds and discuss how investors can evaluate their effectiveness. Understanding the impact of socially responsible index funds. Socially responsible index funds are designed to invest in companies that demonstrate a commitment to sustainability, ethical practices, and positive social impact. These funds typically employ a screening process to identify and include companies that meet specific ESG criteria while excluding those that engage in activities deemed harmful or unethical. The impact of socially responsible index funds can be evaluated based on various factors, including 1. ESG performance. One of the primary ways to evaluate the impact of socially responsible index funds is by assessing the ESG performance of the companies included in the fund. This involves analyzing the environmental practices, social initiatives, and governance structures of the companies to determine their overall sustainability and ethical standards. Investors can review ESG ratings and reports to gain insights into the fund's impact on these factors. 2. Alignment with values. Investors who choose socially responsible index funds often do so because they want their investments to align with their personal values and beliefs. Evaluating the impact of these funds involves assessing whether the companies included in the fund align with the investor's specific values. This can be done by reviewing the fund's investment criteria and examining the company's activities and policies. 3. Positive social and environmental impact. Another important aspect of evaluating the impact of socially responsible index funds is assessing the positive social and environmental impact generated by the companies in the fund. This can include factors such as reducing carbon emissions, promoting diversity and inclusion, supporting community development, and fostering sustainable business practices. Investors can review the fund's impact reports and sustainability disclosures to gain insights into the company's contributions in these areas. 4. Shareholder engagement. Socially responsible index funds often engage with the companies in their portfolios to encourage positive change and promote responsible business practices. Evaluating the impact of these funds involves assessing the level of shareholder engagement and the effectiveness of these efforts. Investors can review the fund's proxy voting records and engagement reports to understand the fund's influence on corporate behavior. Evaluating the effectiveness of socially responsible index funds. When evaluating the effectiveness of socially responsible index funds, investors should consider the following factors. 1. Performance. While the primary goal of socially responsible index funds is to align investments with values, it is essential to evaluate the fund's financial performance. Investors should compare the fund's returns with its benchmark index and other similar funds to determine if it has achieved competitive financial results. It is important to note that socially responsible index funds may have slightly different risk-return profiles compared to traditional index funds due to their specific investment criteria. 2. Transparency and reporting. Investors should look for socially responsible index funds that provide transparent reporting on their ESG criteria, company holdings, and impact metrics. Transparent reporting allows investors to assess the fund's alignment with their values and evaluate the impact of their investments. Look for funds that provide regular updates on their ESG performance and disclose their engagement efforts with portfolio companies. 3. Third-party ratings and certifications. Third-party ratings and certifications can provide valuable insights into the effectiveness of socially responsible index funds. Look for funds that have received high ratings from reputable ESG rating agencies or have obtained certifications such as the United Nations Principles for Responsible Investment (UNPRI). These external validations can help investors assess the fund's commitment to responsible investing and its impact on sustainability and social issues. 4. Long-term impact. Evaluating the impact of socially responsible index funds requires a long-term perspective. Investors should consider the fund's ability to maintain its ESG criteria over time and its impact on driving positive change in the companies it invests in. Look for funds that have a track record of consistent adherence to their investment criteria and have demonstrated a commitment to promoting sustainable business practices. Conclusion. Socially responsible index funds offer investors the opportunity to align their investments with their values while seeking competitive financial returns. Evaluating the impact of these funds involves assessing their ESG performance, alignment with values, positive social and environmental impact, and shareholder engagement. Additionally, investors should consider factors such as performance, transparency and reporting, third-party ratings and certifications, and the long-term impact of the fund. By carefully evaluating these factors, investors can make informed decisions and contribute to positive change through their investment choices. 8.4 Balancing values and returns in index fund investing. When it comes to investing in index funds, one of the key considerations for many investors is finding a balance between their personal values and the desire for financial returns. This is particularly important for socially responsible investors who want to align their investments with their ethical, social, and environmental beliefs. Balancing values and returns in index fund investing requires careful consideration and understanding of the available options. Understanding socially responsible investing. Before delving into the topic of balancing values and returns, it is important to have a clear understanding of socially responsible investing. SRE is an investment approach that seeks to generate both financial returns and positive social or environmental impact. It involves investing in companies or funds that meet certain ethical criteria, such as promoting sustainability, social justice, or corporate governance. SRE can be achieved through various strategies, including exclusionary screening, positive screening, and impact investing. Exclusionary screening involves excluding certain industries or companies from the investment portfolio based on specific criteria, such as involvement in tobacco, weapons, or fossil fuels. Positive screening, on the other hand, focuses on selecting companies that have a positive impact on society or the environment. Impact investing goes a step further by actively seeking investments that generate measurable social or environmental benefits alongside financial returns. Socially responsible index funds. For investors who want to incorporate their values into their index fund investments, socially responsible index funds offer a viable option. These funds are designed to track the performance of a specific socially responsible index, which consists of companies that meet certain environmental, social, and governance (ESG) criteria. Socially responsible index funds provide investors with a way to passively invest in a diversified portfolio of companies that align with their values. When evaluating socially responsible index funds, it is important to consider the specific ESG criteria used by the fund. Different funds may have different methodologies for selecting and weighting companies based on their ESG performance. Some funds may focus on specific themes, such as renewable energy or gender diversity, while others may have a broader set of criteria. Investors should carefully review the fund's prospectus and methodology to ensure that it aligns with their values and investment objectives. Evaluating the impact of socially responsible index funds. While socially responsible index funds offer the opportunity to align investments with personal values, it is also important to evaluate their impact and performance. Investors should consider both the financial returns and the social or environmental impact of these funds. In terms of financial returns, socially responsible index funds may perform similarly to traditional index funds that track broader market indices. However, it is important to note that the performance of socially responsible index funds can vary depending on the specific ESG criteria used and the companies included in the index. Investors should review the historical performance of the fund and compare it to relevant benchmarks to assess its track record. Assessing the social or environmental impact of socially responsible index funds can be more challenging. Investors should look for transparency and disclosure from the fund provider regarding the ESG criteria used and the companies included in the index. Some funds may provide additional information on the positive impact generated by the companies in their portfolio, such as carbon emissions reduction or community development initiatives. Investors can also consider third-party ratings and certifications, such as the Global Reporting Initiative (GRI) or the United Nations Principles for Responsible Investment (PRI), to evaluate the fund's commitment to sustainability and responsible investing. Balancing values and returns. Balancing values and returns in index fund investing requires investors to carefully consider their priorities and objectives. It is important to strike a balance between investing in companies that align with personal values and achieving competitive financial returns. One approach is to allocate a portion of the investment portfolio to socially responsible index funds while maintaining exposure to broader market index funds. This allows investors to diversify their investments and potentially capture the benefits of both approaches. By investing in socially responsible index funds, investors can support companies that align with their values, while also benefiting from the long-term growth potential of the broader market. Another approach is to actively engage with companies and fund providers to advocate for positive change. Investors can use their position as shareholders to influence corporate behavior and encourage companies to improve their ESG performance. This can be done through proxy voting, shareholder resolutions, or direct engagement with company management. By actively participating in the decision-making process, investors can have a greater impact on the companies in which they invest. Ultimately, the key to balancing values and returns in index fund investing is to find a strategy that aligns with personal values while also considering the potential financial implications. By carefully selecting socially responsible index funds, evaluating their impact, and actively engaging with companies, investors can strive to achieve both their financial and ethical goals. 9. Index fund investing for beginners. 9.1 Getting started with index funds. If you're new to investing and looking for a simple and effective way to grow your wealth, index funds can be an excellent option. Index funds offer a passive investment approach that allows you to diversify your portfolio and achieve market returns without the need for extensive research or active management. In this section, we will guide you through the process of getting started with index funds and help you understand the key steps to take on your investment journey. Understanding index funds. Before diving into the world of index fund investing, it's important to have a clear understanding of what index funds are and how they work. An index fund is a type of mutual fund or exchange-traded fund (ETF) that aims to replicate the performance of a specific market index, such as the S&P 500 or the FTSE 100. Instead of trying to outperform the market, index funds seek to match the returns of the index they track. Benefits of index fund investing. One of the primary advantages of investing in index funds is their low cost. Since index funds passively track an index, they require minimal management and have lower expense ratios compared to actively managed funds. This means that more of your investment returns stay in your pocket rather than being eaten up by fees. Another benefit of index funds is their broad diversification. By investing in an index fund, you gain exposure to a wide range of stocks or bonds within the index. This diversification helps reduce the risk associated with investing in individual securities and can provide a more stable and consistent return over the long term. Steps to get started. Educate yourself. Before investing in index funds, it's crucial to educate yourself about the basics of investing and understand the principles of index fund investing. Read books, articles, and reputable online resources to gain knowledge and build a solid foundation. Set investment goals. Determine your investment goals and time horizon. Are you investing for retirement, a down payment on a house, or a child's education? Understanding your goals will help you determine the appropriate investment strategy and asset allocation. Assess risk tolerance. Evaluate your risk tolerance by considering your financial situation, investment knowledge, and comfort level with market fluctuations. This assessment will help you determine the appropriate mix of stocks, bonds, and other asset classes for your portfolio. Choose a brokerage account. Open a brokerage account with a reputable financial institution that offers access to a wide range of index funds. Consider factors such as account fees, investment options, customer service, and user-friendly platforms. Select the right index funds. Research and select index funds that align with your investment goals and risk tolerance. Look for funds with low expense ratios, a solid track record, and a good reputation. Consider diversifying your portfolio by investing in funds that track different market segments or asset classes. Determine asset allocation. Decide on the appropriate asset allocation for your portfolio based on your risk tolerance and investment goals. This involves determining the percentage of your portfolio allocated to stocks, bonds, and other asset classes. A common rule of thumb is to subtract your age from 100 to determine the percentage of your portfolio allocated to stocks. Invest regularly. Set up a systematic investment plan where you contribute a fixed amount of money to your index fund portfolio on a regular basis. This approach, known as dollar cost averaging, allows you to buy more shares when prices are low and fewer shares when prices are high, potentially reducing the impact of market volatility. Monitor and rebalance. Regularly review your portfolio to ensure it remains aligned with your asset allocation targets. Over time, certain asset classes may outperform or underperform, causing your portfolio to deviate from your desired allocation. Rebalancing involves selling overperforming assets and buying underperforming assets to bring your portfolio back in line with your target allocation. Stay disciplined. One of the key principles of successful index fund investing is to stay disciplined and avoid making emotional investment decisions based on short-term market fluctuations. Stick to your investment plan and avoid trying to time the market or chase hot investment trends. Continue learning. Index fund investing is a long-term journey, and there is always more to learn. Stay informed about market trends, investment strategies, and new index fund offerings. Regularly review your investment plan and make adjustments as needed to stay on track with your goals. By following these steps and staying committed to your investment plan, you can start your journey as an index fund investor with confidence. Remember, index fund investing is a long-term strategy that requires patience and discipline. Over time, the power of compounding and the benefits of low-cost, diversified investing can help you achieve your financial goals. 9.2 Setting investment goals. When it comes to investing in index funds, setting clear investment goals is crucial. Your investment goals will serve as a roadmap for your investment journey, helping you make informed decisions and stay focused on achieving your financial objectives. In this section, we will explore the importance of setting investment goals and provide guidance on how to establish goals that align with your financial aspirations. Why are investment goals important? Setting investment goals is essential for several reasons. Here are a few key benefits. Clarity and focus. Establishing clear investment goals helps you define what you want to achieve with your investments. It provides a sense of direction and focus, allowing you to make informed decisions that align with your objectives. Motivation. Having well-defined investment goals can serve as a source of motivation. When you have a clear vision of what you want to accomplish, it becomes easier to stay committed to your investment strategy, especially during periods of market volatility or uncertainty. Measuring progress. Investment goals act as benchmarks for measuring your progress. By regularly reviewing your goals, you can assess how well your investments are performing and make any necessary adjustments to stay on track. Risk management. Setting investment goals helps you determine your risk tolerance. Different goals may require different levels of risk, and understanding your risk tolerance will help you select appropriate index funds that align with your comfort level. Establishing investment goals. To set effective investment goals, consider the following steps. 1. Define your financial objectives. Start by identifying your financial objectives. Are you investing for retirement, purchasing a home, funding your child's education, or simply building wealth? Each objective may have a different time horizon and risk tolerance, so it's important to be specific about what you want to achieve. 2. Determine your time horizon. Consider the time frame within which you hope to achieve your goals. Short-term goals, such as saving for a down payment on a house, may have a time horizon of a few years, while long-term goals like retirement planning may span several decades. Understanding your time horizon will help you select appropriate investment strategies and asset allocations. 3. Assess your risk tolerance. Evaluate your risk tolerance by considering factors such as your age, financial stability, and comfort level with market fluctuations. If you have a longer time horizon and can tolerate higher volatility, you may be more comfortable with a higher allocation to equities. On the other hand, if you have a shorter time horizon or are risk-averse, a more conservative allocation may be suitable. 4. Quantify your goals. Assign a specific monetary value to each of your investment goals. This will help you determine how much you need to save and invest to achieve each objective. Be realistic in your estimations and consider factors such as inflation and potential investment returns. 5. Prioritize your goals. If you have multiple investment goals, prioritize them based on their importance and urgency. This will help you allocate your resources effectively and focus on the goals that matter most to you. 6. Review and adjust. Regularly review your investment goals to ensure they remain relevant and aligned with your changing circumstances. As you progress towards achieving your goals, you may need to make adjustments to your investment strategy or time horizon. Example investment goals. To illustrate how investment goals can be established, here are a few examples. Retirement planning. Goal: save $1 million for retirement in 25 years. Time horizon: 25 years. Risk tolerance: moderate to high. Strategy: invest in a diversified portfolio of equity and bond index funds. Education fund. Goal: save $50,000 for your child's college education in 15 years. Time horizon: 15 years. Risk tolerance: moderate. Strategy: invest in a mix of equity and bond index funds with a slightly more conservative allocation as the time horizon approaches. Wealth accumulation. Goal: build a portfolio worth $500,000 in 20 years. Time horizon: 20 years. Risk tolerance: moderate to high. Strategy: invest in a diversified portfolio of equity index funds, focusing on long-term growth. Remember, these examples are for illustrative purposes only. Your investment goals should be tailored to your unique financial situation, risk tolerance, and aspirations. Conclusion. Setting investment goals is a critical step in index fund investing. By defining your financial objectives, determining your time horizon, assessing your risk tolerance, and quantifying your goals, you can establish a clear roadmap for your investment journey. Regularly reviewing and adjusting your goals will ensure they remain relevant and aligned with your changing circumstances. With well-defined investment goals, you can make informed decisions and stay focused on achieving your financial aspirations. 9.3 Creating an index fund portfolio. Creating an index fund portfolio is a straightforward and effective way to invest in the stock market. By diversifying your investments across a range of index funds, you can achieve broad market exposure and potentially reduce risk. In this section, we will discuss the steps involved in creating an index fund portfolio and provide some tips to help you get started. Step 1. Determine your investment goals. Before you start building your index fund portfolio, it's important to determine your investment goals. Are you investing for retirement, saving for a down payment on a house, or planning for your child's education? Understanding your goals will help you determine the appropriate asset allocation and investment strategy for your portfolio. Step 2. Choose the right asset allocation. Asset allocation refers to the distribution of your investments across different asset classes, such as stocks, bonds, and cash. The right asset allocation for your index fund portfolio will depend on your risk tolerance, time horizon, and investment goals. Generally, a younger investor with a longer time horizon can afford to take on more risk and allocate a higher percentage of their portfolio to stocks. On the other hand, a more conservative investor nearing retirement may prefer a higher allocation to bonds. Step 3. Select the appropriate index funds. Once you have determined your asset allocation, the next step is to select the appropriate index funds for your portfolio. There are a wide variety of index funds available, each tracking a specific market index or asset class. For example, you may choose to invest in a broad market index fund that tracks the performance of the entire stock market, or you may opt for sector-specific index funds that focus on specific industries such as technology or healthcare. When selecting index funds, it's important to consider factors such as expense ratios, tracking error, and fund performance. Look for index funds with low expense ratios, as these fees can eat into your returns over time. Additionally, consider the fund's tracking error, which measures how closely the fund's performance matches that of its underlying index. A lower tracking error indicates a more accurate replication of the index's returns. Step 4. Diversify your portfolio. Diversification is a key principle of investing and involves spreading your investments across different asset classes, sectors, and geographic regions. By diversifying your index fund portfolio, you can potentially reduce risk and increase the likelihood of achieving consistent returns. For example, if you invest solely in a single sector index fund, your portfolio will be highly exposed to the performance of that sector. However, by diversifying across multiple sectors and asset classes, you can mitigate the impact of any one investment's poor performance. Step 5. Rebalance regularly. Once you have built your index fund portfolio, it's important to regularly rebalance your investments. Rebalancing involves adjusting the allocation of your portfolio back to its original target percentages. Over time, certain investments may outperform others, causing your portfolio to become unbalanced. By rebalancing, you can ensure that your portfolio remains aligned with your desired asset allocation. Step 6. Stay the course. One of the key principles of successful index fund investing is to stay the course and avoid making emotional investment decisions. Market fluctuations and short-term volatility are a normal part of investing. It's important to remember that index funds are designed for long-term investing, and trying to time the market or make frequent changes to your portfolio can be detrimental to your returns. Instead, focus on your long-term investment goals and stick to your predetermined asset allocation and investment strategy. Tips for creating an index fund portfolio. Start with a solid foundation. Begin by investing in broad market index funds that provide exposure to the entire stock market. These funds can serve as the core holdings of your portfolio. Consider your risk tolerance. If you have a higher risk tolerance, you may choose to allocate a larger percentage of your portfolio to stocks. Conversely, if you have a lower risk tolerance, you may prefer a higher allocation to bonds or cash. Don't overlook international markets. Including international index funds in your portfolio can provide diversification and exposure to global markets. Consider investing in both developed and emerging market index funds to capture opportunities outside of your home country. Regularly review and adjust your portfolio. As your investment goals and financial situation change, it's important to review and adjust your index fund portfolio accordingly. Regularly monitor your investments and make any necessary changes to keep your portfolio aligned with your goals. Seek professional advice if needed. If you are unsure about how to create an index fund portfolio or need assistance with asset allocation, consider seeking advice from a financial advisor. They can provide personalized guidance based on your individual circumstances and help you make informed investment decisions. By following these steps and tips, you can create a well-diversified index fund portfolio that aligns with your investment goals and risk tolerance. Remember to stay disciplined, focus on the long term, and regularly review and adjust your portfolio as needed. Happy investing! 9.4 Common mistakes to avoid in index fund investing. Index fund investing has gained popularity among investors due to its simplicity, low costs, and potential for long-term returns. However, like any investment strategy, there are common mistakes that investors should avoid to maximize their success. In this section, we will discuss some of the most common mistakes to avoid in index fund investing. 1. Neglecting to diversify. One of the key principles of successful investing is diversification. While index funds inherently provide diversification by investing in a broad range of securities, it is still important to diversify across different asset classes and sectors. Neglecting to diversify your index fund portfolio can expose you to unnecessary risk. By spreading your investments across various asset classes, such as stocks, bonds, and real estate, you can reduce the impact of any single investment on your overall portfolio. 2. Timing the market. Attempting to time the market is a common mistake made by many investors, and it can be particularly detrimental when investing in index funds. Index funds are designed to track the performance of a specific market index, and trying to predict short-term market movements can lead to missed opportunities and increased transaction costs. Instead of trying to time the market, focus on your long-term investment goals and stay invested for the duration of your investment horizon. 3. Overreacting to market volatility. Market volatility is a natural part of investing, and it is important to avoid overreacting to short-term fluctuations. Selling your index fund holdings during periods of market downturns can lock in losses and prevent you from benefiting from potential market recoveries. It is crucial to maintain a long-term perspective and stay committed to your investment strategy, even during times of market uncertainty. 4. Chasing performance. Another common mistake is chasing past performance. It can be tempting to invest in index funds that have recently delivered high returns, but this approach is not a reliable indicator of future performance. Instead, focus on the fundamentals of the index fund, such as its expense ratio, tracking error, and the underlying index it tracks. A well-constructed index fund with a solid track record is more likely to provide consistent returns over the long term. 5. Ignoring costs. While index funds are known for their low costs compared to actively managed funds, it is still important to pay attention to the expenses associated with your investments. Expenses such as management fees and transaction costs can eat into your returns over time. Compare the expense ratios of different index funds and choose those with lower costs, as this can have a significant impact on your long-term investment performance. 6. Failing to rebalance. Rebalancing is an essential part of maintaining a well-diversified index fund portfolio. Over time, the performance of different asset classes can vary, causing your portfolio to deviate from your desired asset allocation. Failing to rebalance can result in an overweighting or underweighting of certain asset classes, which can expose your portfolio to unnecessary risk. Regularly review your portfolio and rebalance as needed to ensure that your investments align with your long-term goals. 7. Neglecting to consider taxes. Taxes can have a significant impact on your investment returns, and it is important to consider the tax implications of your index fund investments. Index funds that generate dividends or capital gains can result in taxable income, which can reduce your overall returns. Consider investing in tax-efficient index funds or utilizing tax-advantaged accounts such as IRAs or 401k plans to minimize the impact of taxes on your investment returns. 8. Lack of patience. Successful index fund investing requires patience and a long-term perspective. It is important to resist the temptation to make frequent changes to your portfolio based on short-term market movements or news headlines. Stick to your investment plan and give your investments time to grow and compound over the long term. Remember that index fund investing is a marathon, not a sprint. 9. Failing to stay informed. While index fund investing is relatively straightforward, it is still important to stay informed about the market and the performance of your investments. Keep track of the performance of the index funds in your portfolio, monitor any changes in the underlying index, and stay updated on any news or developments that may impact your investments. By staying informed, you can make more informed decisions and adjust your investment strategy as needed. 10. Emotional investing. Emotions can be a significant driver of investment decisions, and it is important to avoid making investment choices based on fear or greed. Emotional investing can lead to impulsive decisions that may not align with your long-term investment goals. Develop a disciplined investment approach and stick to your plan, regardless of short-term market fluctuations or external influences. By avoiding these common mistakes, you can enhance your chances of success in index fund investing. Remember to stay focused on your long-term goals, maintain a diversified portfolio, and regularly review and rebalance your investments. With patience, discipline, and a well-informed approach, index fund investing can be a powerful strategy for building wealth over time. 10. Index fund investing for active investors. 10.1 Combining index funds with active strategies. While index funds are known for their passive investment approach, some investors may choose to combine index funds with active strategies to potentially enhance their investment returns. This combination allows investors to benefit from the diversification and low costs of index funds while also taking advantage of active management techniques. In this section, we will explore the concept of combining index funds with active strategies and discuss some popular approaches. Understanding active strategies. Active strategies involve actively managing a portfolio with the goal of outperforming a specific benchmark or the overall market. Active managers rely on their expertise, research, and analysis to make investment decisions. They may engage in stock picking, market timing, sector rotation, or other tactics to generate higher returns. Active strategies can be appealing to investors who believe that skilled managers can consistently outperform the market. However, it is important to note that active management comes with higher costs, including management fees and transaction costs. Additionally, research has shown that a significant majority of active managers fail to consistently beat their benchmarks over the long term. The benefits of combining index funds with active strategies. By combining index funds with active strategies, investors can potentially benefit from the best of both worlds. Here are some advantages of this approach. Diversification. Index funds provide broad market exposure, which helps to reduce the risk associated with individual stock selection. By combining index funds with active strategies, investors can further diversify their portfolios and potentially reduce the impact of any single investment. Cost efficiency. Index funds are known for their low expense ratios compared to actively managed funds. By incorporating index funds into an active strategy, investors can keep their overall investment costs lower while still having the potential for outperformance. Risk management. Active strategies can be used to manage risk by adjusting the portfolio's exposure to different asset classes or sectors based on market conditions. By combining active strategies with index funds, investors can potentially enhance their risk management capabilities. Flexibility. Combining index funds with active strategies allows investors to have flexibility in their investment approach. They can allocate a portion of their portfolio to index funds for long-term, low-cost exposure to the market, while actively managing another portion to take advantage of short-term opportunities or market inefficiencies. Popular approaches to combining index funds with active strategies. There are several popular approaches that investors can consider when combining index funds with active strategies. Here are a few examples. Core satellite approach. This approach involves building a core portfolio using index funds to provide broad market exposure. The core portfolio is then supplemented with satellite positions managed actively to potentially generate additional returns. The satellite positions can be focused on specific sectors, regions, or investment themes. Tactical asset allocation. Tactical asset allocation involves adjusting the portfolio's asset allocation based on short-term market conditions. This approach aims to take advantage of market trends and opportunities by overweighting or underweighting certain asset classes or sectors. Index funds can be used as the core holdings, while active strategies are employed to make tactical adjustments. Factor investing. Factor investing focuses on capturing specific risk factors that have historically been associated with higher returns. By combining index funds with active strategies that target factors such as value, momentum, or quality, investors can potentially enhance their portfolio's risk-adjusted returns. Active overlay. An active overlay strategy involves using active management techniques to adjust the risk and return characteristics of an index fund portfolio. This can be done by actively managing the asset allocation, hedging against downside risk, or implementing tactical adjustments based on market conditions. Considerations and risks. While combining index funds with active strategies can offer potential benefits, it is important for investors to consider the following. Costs. Active strategies typically come with higher costs compared to index funds. Investors should carefully evaluate the fees associated with active management and assess whether the potential benefits outweigh the additional expenses. Performance. Active strategies are not guaranteed to outperform the market or their benchmarks. Investors should thoroughly research and evaluate the track record and expertise of active managers before incorporating them into their portfolio. Time and effort. Active strategies require ongoing monitoring and decision-making. Investors should be prepared to dedicate time and effort to stay informed about market trends, economic conditions, and the performance of their active strategies. Risk of underperformance. Active strategies can also underperform the market or their benchmarks. Investors should be prepared for the possibility of lower returns compared to a purely passive index fund approach. In conclusion, combining index funds with active strategies can be a viable approach for investors seeking to potentially enhance their investment returns. By carefully considering the benefits, risks, and costs associated with active management, investors can create a well-rounded portfolio that combines the advantages of both passive and active investing. 10.2 Tactical asset allocation with index funds. Tactical asset allocation is a strategy that involves actively adjusting the allocation of assets in a portfolio based on short-term market conditions. While index funds are typically associated with passive investing, they can also be used in a tactical asset allocation approach. In this section, we will explore how index funds can be utilized in a tactical asset allocation strategy and the considerations investors should keep in mind. Understanding tactical asset allocation. Tactical asset allocation aims to take advantage of short-term market opportunities by adjusting the allocation of assets in a portfolio. Unlike strategic asset allocation, which focuses on long-term goals and maintains a fixed allocation, tactical asset allocation involves making changes based on market conditions. The goal of tactical asset allocation is to enhance returns or reduce risk by overweighting or underweighting certain asset classes or sectors. This strategy requires active monitoring of market trends, economic indicators, and other factors that may impact asset prices. Incorporating index funds in tactical asset allocation. Index funds can play a valuable role in a tactical asset allocation strategy due to their low costs, broad market exposure, and ease of trading. Here are a few ways investors can incorporate index funds into their tactical asset allocation approach. 1. Sector rotation. Sector rotation involves shifting investments between different sectors of the economy based on their relative strength or weakness. By using sector-specific index funds, investors can easily adjust their exposure to different sectors as market conditions change. For example, during an economic expansion, sectors such as technology or consumer discretionary may outperform, while defensive sectors like utilities or consumer staples may lag. By overweighting the outperforming sectors and underweighting the underperforming ones, investors can potentially enhance their returns. 2. Style rotation. Similar to sector rotation, style rotation involves shifting investments between different investment styles, such as growth and value. Index funds tracking specific investment styles can be used to implement this strategy. During certain market cycles, either growth or value stocks may outperform the other. By adjusting the allocation between growth and value index funds, investors can capitalize on these trends and potentially enhance their portfolio returns. 3. Market cap rotation. Market capitalization rotation involves adjusting the allocation between large cap, mid cap, and small cap stocks based on their relative performance. Index funds tracking different market capitalization segments can be used to implement this strategy. In some market environments, small cap stocks may outperform large cap stocks, while in others, the opposite may be true. By tactically adjusting the allocation between different market cap index funds, investors can potentially benefit from these market trends. 4. Country allocation. For investors interested in international exposure, tactical asset allocation can also involve adjusting the allocation between different countries or regions. Index funds tracking specific countries or regions can be used to implement this strategy. By monitoring economic indicators, geopolitical events, and other factors, investors can adjust their allocation to different countries or regions based on their outlook. This approach allows investors to potentially benefit from the performance of specific countries or regions while managing risk. Considerations for tactical asset allocation with index funds. While tactical asset allocation with index funds can be an effective strategy, there are a few considerations investors should keep in mind. 1. Active monitoring. Tactical asset allocation requires active monitoring of market conditions and economic indicators. Investors need to stay informed about market trends, news, and events that may impact asset prices. Regular review and adjustment of the portfolio are necessary to implement this strategy effectively. 2. Risk management. Tactical asset allocation involves taking on additional risk compared to a passive buy and hold strategy. Investors need to carefully assess their risk tolerance and ensure that the tactical adjustments align with their investment goals and risk appetite. 3. Costs. While index funds are known for their low costs, frequent trading and adjustments in a tactical asset allocation strategy can lead to increased transaction costs. Investors should consider the impact of trading costs on their overall returns and factor them into their decision-making process. 4. Discipline. Successful tactical asset allocation requires discipline and a long-term perspective. It is essential to avoid making impulsive decisions based on short-term market fluctuations. Investors should have a well-defined investment plan and stick to it, even during periods of market volatility. Conclusion. Tactical asset allocation with index funds can be a powerful strategy for investors looking to actively manage their portfolios. By incorporating index funds in sector rotation, style rotation, market cap rotation, or country allocation, investors can potentially enhance their returns and manage risk. However, it is crucial to carefully monitor market conditions, manage risk effectively, consider costs, and maintain discipline to implement this strategy successfully. 10.3 Using index funds for market timing. Market timing is the practice of trying to predict the future movements of the stock market in order to make investment decisions. It involves buying and selling securities based on anticipated market trends, with the goal of buying low and selling high. While market timing can be tempting, it is widely regarded as a challenging and risky strategy. However, some investors may wonder if index funds can be used for market timing purposes. In this section, we will explore the concept of using index funds for market timing and discuss its potential benefits and drawbacks. Understanding market timing. Market timing is based on the belief that it is possible to predict the short-term movements of the stock market. Proponents of market timing argue that by correctly identifying market trends, investors can maximize their returns and minimize their losses. However, numerous studies have shown that consistently timing the market is extremely difficult, if not impossible, to achieve. The stock market is influenced by a multitude of factors, including economic indicators, geopolitical events, and investor sentiment. These factors are often unpredictable and can lead to sudden and unexpected market movements. Trying to time the market requires accurately predicting these factors and their impact on stock prices, which is a challenging task even for experienced professionals. Index funds and market timing. Index funds are designed to track the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. They aim to replicate the returns of the index by holding a diversified portfolio of securities that mirror the index's composition. As passive investment vehicles, index funds are not actively managed, and their holdings are adjusted only when the underlying index changes. Given their passive nature, index funds are not typically used for market timing purposes. Instead, they are commonly employed as long-term investment vehicles that provide broad market exposure and diversification. The primary goal of index fund investing is to capture the overall market returns over the long term, rather than trying to time short-term market movements. Benefits of using index funds for market timing. While market timing with index funds is not a recommended strategy, there are a few potential benefits that some investors may consider. Flexibility. Index funds can be bought and sold throughout the trading day, allowing investors to react quickly to market movements. This flexibility can be appealing to those who believe they can accurately time the market. Diversification. Index funds provide exposure to a broad range of securities within a specific market index. This diversification can help mitigate the risks associated with individual stock picking and potentially reduce the impact of market timing errors. Cost effectiveness. Index funds generally have lower expense ratios compared to actively managed funds. This cost advantage can be beneficial for investors who want to engage in frequent trading or market timing strategies. Drawbacks of using index funds for market timing. While there may be some potential benefits, it is important to consider the drawbacks of using index funds for market timing. Difficulty in timing the market. As mentioned earlier, consistently timing the market is extremely challenging. Even experienced professionals struggle to consistently predict short-term market movements. Individual investors are unlikely to have the necessary resources, expertise, or access to timely information to successfully time the market. Transaction costs. Frequent buying and selling of index funds can lead to increased transaction costs, including brokerage fees and potential capital gains taxes. These costs can eat into investment returns and erode the benefits of market timing. Emotional biases. Market timing often involves making investment decisions based on emotions and short-term market fluctuations. Emotional biases, such as fear and greed, can cloud judgment and lead to poor investment decisions. Index fund investing, on the other hand, encourages a disciplined, long-term approach that focuses on the fundamentals of the market. The role of index funds in a long-term investment strategy. While market timing with index funds may not be a recommended strategy, index funds can still play a valuable role in a long-term investment strategy. By providing broad market exposure, low costs, and diversification, index funds can serve as the foundation of a well-diversified portfolio. Rather than trying to time the market, investors can focus on factors within their control, such as asset allocation, diversification, and regular contributions. By maintaining a disciplined approach and staying invested for the long term, investors can potentially benefit from the compounding returns of the market. In conclusion, using index funds for market timing is generally not recommended. Market timing is a challenging and risky strategy that even experienced professionals struggle to execute successfully. Index funds are better suited for long-term investing, providing broad market exposure and diversification. By adopting a disciplined approach and focusing on factors within their control, investors can build a solid foundation for their investment portfolio using index funds. 10.4 Active trading with index funds. Active trading refers to the practice of buying and selling securities frequently in an attempt to profit from short-term price fluctuations. While index funds are typically associated with a passive investment strategy, there are some investors who attempt to use index funds for active trading purposes. In this section, we will explore the concept of active trading with index funds and discuss its advantages, disadvantages, and considerations. Understanding active trading with index funds. Active trading with index funds involves using these funds as a tool for short-term trading strategies. Instead of holding index funds for the long term, active traders aim to take advantage of market movements and generate profits through frequent buying and selling of index fund shares. This approach requires a high level of involvement, as active traders closely monitor market trends, news, and technical indicators to make quick trading decisions. Advantages of active trading with index funds. Liquidity. Index funds are highly liquid, meaning they can be bought or sold quickly at market prices. This makes them suitable for active traders who need to enter and exit positions swiftly. Diversification. Index funds provide instant diversification by holding a basket of securities that represent a specific market index. This diversification can help mitigate risk and potentially enhance returns for active traders. Lower costs. Index funds generally have lower expense ratios compared to actively managed funds. This can be advantageous for active traders who frequently buy and sell funds, as lower costs can help preserve more of their trading profits. Transparency. Index funds disclose their holdings regularly, allowing active traders to analyze the underlying securities and make informed trading decisions based on the composition of the index. Disadvantages of active trading with index funds. Transaction costs. Frequent buying and selling of index funds can lead to increased transaction costs, including brokerage fees and bid-ask spreads. These costs can eat into the potential profits of active traders. Taxes. Active trading can generate short-term capital gains, which are typically taxed at higher rates than long-term capital gains. This can reduce the overall after-tax returns for active traders. Market timing risks. Active trading relies on accurately predicting short-term market movements. However, consistently timing the market is challenging, and even experienced traders often struggle to consistently outperform the market. Emotional bias. Active trading can be emotionally demanding, as traders may be tempted to make impulsive decisions based on short-term market fluctuations. Emotional biases can lead to poor trading outcomes and erode potential profits. Considerations for active trading with index funds. Time commitment. Active trading requires a significant time commitment, as traders need to stay informed about market trends, news, and technical indicators. It is essential to assess whether you have the time and resources to actively trade index funds effectively. Risk management. Active traders should have a well-defined risk management strategy in place. This includes setting stop-loss orders, diversifying their trading positions, and having a clear understanding of their risk tolerance. Education and experience. Active trading requires a solid understanding of market dynamics, technical analysis, and trading strategies. It is crucial to educate yourself and gain experience before engaging in active trading with index funds. Monitoring and discipline. Active traders need to closely monitor their positions and exercise discipline in executing their trading strategies. This includes sticking to predetermined entry and exit points and avoiding impulsive trading decisions. Conclusion. Active trading with index funds can be an appealing strategy for some investors looking to capitalize on short-term market movements. However, it is important to recognize the challenges and risks associated with active trading, including transaction costs, taxes, market timing risks, and emotional biases. Before engaging in active trading with index funds, investors should carefully consider their time commitment, risk management strategies, and level of knowledge and experience. It is also essential to regularly evaluate the performance of active trading strategies and make adjustments as needed. 11. Index fund investing in a changing market. 11.1 Market volatility and index fund investing. Investing in index funds can be a smart and effective way to grow your wealth over the long term. These funds offer diversification, low costs, and the potential for market-matching returns. However, like any investment, index funds are not immune to market volatility. Understanding how market volatility can impact index fund investing is crucial for investors looking to navigate changing market conditions. What is market volatility? Market volatility refers to the rapid and significant price fluctuations of financial assets within a given market. It is often driven by various factors such as economic indicators, geopolitical events, investor sentiment, and market speculation. Volatility can be measured using statistical tools like standard deviation or by observing the frequency and magnitude of price swings. Impact of market volatility on index funds. Index funds are designed to track the performance of a specific market index, such as the S&P 500 or the FTSE 100. As a result, they are directly influenced by the movements of the underlying index. When the market experiences volatility, index funds will reflect those fluctuations. During periods of high market volatility, index funds may experience increased price swings. This can be attributed to the fact that index funds hold a diversified portfolio of securities that mirror the composition of the underlying index. If the index experiences significant price fluctuations, the value of the index fund will also fluctuate accordingly. It's important to note that market volatility affects all types of investments, not just index funds. However, index funds can provide some advantages during volatile market conditions. Benefits of index funds in volatile markets. Diversification. Index funds offer broad market exposure by investing in a wide range of securities within a specific index. This diversification helps to spread risk and can mitigate the impact of volatility on the overall portfolio. By holding a diversified index fund, investors can potentially reduce the impact of individual stock or sector-specific volatility. Lower costs. Index funds are known for their low expense ratios compared to actively managed funds. During periods of market volatility, actively managed funds may experience higher trading costs as fund managers adjust their portfolios. In contrast, index funds typically have lower turnover and fewer transaction costs, making them a cost-effective option for investors. Long-term focus. Index funds are designed for long-term investors who aim to capture the overall market returns. While short-term market volatility can be unsettling, index fund investors can take comfort in the knowledge that historically, markets have recovered from downturns and delivered positive returns over the long term. By maintaining a long-term perspective, investors can avoid making impulsive decisions based on short-term market fluctuations. Transparency. Index funds are transparent in nature, as their holdings are publicly disclosed. This transparency allows investors to understand the composition of the fund and make informed decisions. During periods of market volatility, this transparency can be particularly valuable, as investors can assess the fund's exposure to specific sectors or industries that may be more susceptible to volatility. Strategies for navigating market volatility with index funds. While index funds can provide stability and long-term growth potential, it's important to have a strategy in place to navigate market volatility effectively. Here are a few strategies to consider. Stay the course. During periods of market volatility, it's crucial to stay focused on your long-term investment goals. Avoid making impulsive decisions based on short-term market movements. Remember that index funds are designed to capture the overall market returns over time, and market downturns are often followed by recoveries. Dollar cost averaging. Consider implementing a dollar cost averaging strategy, where you invest a fixed amount of money at regular intervals, regardless of market conditions. This approach allows you to buy more shares when prices are low and fewer shares when prices are high, potentially reducing the impact of market volatility on your overall investment. Rebalance regularly. Periodically review and rebalance your index fund portfolio to maintain your desired asset allocation. During market volatility, certain asset classes may outperform or underperform, causing your portfolio to deviate from your target allocation. Rebalancing ensures that you sell high and buy low, effectively taking advantage of market fluctuations. Consider hedging strategies. If you are particularly concerned about market volatility, you may explore hedging strategies such as purchasing put options or using inverse index funds. These strategies can help offset potential losses during market downturns but should be approached with caution and only after thorough research and understanding. Diversify across asset classes. In addition to diversifying within an index fund, consider diversifying across different asset classes such as bonds, real estate, or international equities. This broader diversification can help reduce the impact of market volatility on your overall portfolio. Remember, market volatility is a natural part of investing, and it's important to approach it with a long-term perspective. By understanding the impact of market volatility on index funds and implementing appropriate strategies, investors can navigate changing market conditions and stay on track towards their investment goals. 11.2 Index funds in bull markets. In a bull market, where stock prices are rising and investor confidence is high, index funds can be a valuable investment tool. Index funds are designed to track the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. These funds offer investors a way to gain exposure to a broad range of stocks within a particular market segment or the overall market. During a bull market, index funds can provide several benefits to investors. Here are some key advantages of investing in index funds in bull markets. 1. Diversification. One of the primary advantages of index funds is their ability to provide instant diversification. By investing in an index fund, you gain exposure to a basket of stocks that make up the underlying index. This diversification helps to spread the risk across multiple companies and sectors, reducing the impact of any individual stock's performance on your overall investment. In a bull market, where many stocks are experiencing positive growth, index funds allow you to participate in the overall market upswing. 2. Low costs. Index funds are known for their low expense ratios compared to actively managed funds. This is because index funds aim to replicate the performance of a specific index rather than relying on active management and stock picking. Lower costs mean that more of your investment returns stay in your pocket, allowing you to benefit from the overall market gains during a bull market. 3. Consistent performance. Index funds are designed to closely track the performance of their underlying index. This means that during a bull market, when the overall market is experiencing positive growth, index funds tend to deliver consistent returns. While individual stocks may experience volatility, the diversification provided by index funds helps to smooth out the ups and downs, resulting in more stable and predictable performance. 4. Accessibility. Index funds are widely available and accessible to investors of all levels. They can be purchased through brokerage accounts, retirement plans, and even some robo-advisors. This accessibility allows investors to easily participate in a bull market and take advantage of the upward trend in stock prices. 5. Passive investing. Index funds are a popular choice for passive investors who prefer a hands-off approach to investing. With index funds, you don't need to spend time researching and analyzing individual stocks. Instead, you can simply invest in a fund that tracks a specific index and let the market do the work for you. This passive investing strategy is well suited for bull markets, where the overall market trend is positive. 6. Long-term growth potential. Bull markets are often characterized by extended periods of positive market performance. By investing in index funds during a bull market, you position yourself to benefit from the long-term growth potential of the market. Over time, the compounding effect of consistent market gains can lead to significant wealth accumulation. 7. Risk mitigation. While bull markets are generally associated with positive market conditions, there is always the potential for market volatility in downturns. By investing in index funds, you can mitigate some of the risks associated with individual stock selection. The diversification provided by index funds helps to reduce the impact of any single stock's poor performance on your overall investment. 8. Flexibility. Index funds offer investors flexibility in terms of investment options. There are index funds available that track various market segments, such as large cap, small cap, international, or sector-specific indexes. This flexibility allows investors to tailor their investment strategy to their specific goals and risk tolerance. 9. Transparency. Index funds are transparent investment vehicles. The underlying index and the holdings of the fund are publicly available information. This transparency allows investors to understand exactly what they are investing in and make informed decisions based on the composition of the index fund. 10. Lower emotional bias. Investing in index funds can help reduce emotional bias in decision-making. During a bull market, when stock prices are rising, it can be tempting to chase high-flying stocks or make impulsive investment decisions. However, by investing in index funds, you are less likely to be swayed by short-term market fluctuations or individual stock performance. This disciplined approach can lead to better long-term investment outcomes. In conclusion, index funds can be an excellent investment choice during bull markets. They offer diversification, low costs, consistent performance, accessibility, and passive investing benefits. By investing in index funds, you can participate in the overall market upswing, mitigate risk, and position yourself for long-term growth. However, it's important to remember that past performance is not indicative of future results, and market conditions can change. Therefore, it's crucial to review your investment strategy regularly and make adjustments as needed to adapt to evolving market conditions. 11.3 Index funds in bear markets. In the world of investing, bear markets are often seen as a time of uncertainty and fear. These are periods when stock prices decline significantly, and investor sentiment turns negative. During bear markets, many investors panic and rush to sell their investments, fearing further losses. However, for index fund investors, bear markets can present unique opportunities. Understanding bear markets. Before we delve into the role of index funds in bear markets, it's important to understand what a bear market is. A bear market is typically defined as a sustained period of declining stock prices, usually accompanied by a pessimistic outlook on the economy. Bear markets can be caused by various factors, such as economic recessions, geopolitical tensions, or financial crises. During bear markets, stock prices can experience significant declines, sometimes reaching double-digit or even triple-digit percentage losses. This can be a challenging time for investors, as the value of their portfolios may decrease substantially. However, it's important to remember that bear markets are a normal part of the market cycle and have historically been followed by periods of recovery and growth. The role of index funds in bear markets. Index funds can play a crucial role in bear markets due to their passive investment approach and broad market exposure. Unlike actively managed funds, which aim to outperform the market through stock selection and market timing, index funds aim to replicate the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. During bear markets, index funds can provide investors with several advantages. Firstly, index funds offer diversification across a wide range of stocks within a particular index. This diversification helps to spread risk and reduce the impact of individual stock declines. By investing in an index fund, investors gain exposure to a broad market segment rather than relying on the performance of a few individual stocks. Secondly, index funds have lower expense ratios compared to actively managed funds. This is because index funds do not require active management or extensive research, as they aim to replicate the performance of a specific index. Lower expenses can be particularly beneficial during bear markets when investment returns may be lower or negative. By minimizing costs, index funds can help investors preserve more of their investment capital. Thirdly, index funds offer a long-term investment approach that aligns with the principles of successful investing. During bear markets, it's crucial to maintain a long-term perspective and avoid making impulsive investment decisions based on short-term market fluctuations. Index funds, with their focus on long-term market performance, can help investors stay disciplined and avoid emotional reactions to market downturns. Dollar cost averaging in bear markets. One strategy that can be particularly effective during bear markets is dollar cost averaging, DCA. DCA involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy allows investors to buy more shares when prices are low and fewer shares when prices are high. During bear markets, DCA can be advantageous as it takes advantage of the market's volatility. By consistently investing a fixed amount, investors can accumulate more shares when prices are depressed, potentially benefiting from the eventual market recovery. DCA helps to mitigate the risk of making large investments at the wrong time and reduces the impact of short-term market fluctuations. Index funds are well suited for implementing a DCA strategy due to their low costs and broad market exposure. By investing in an index fund through regular contributions, investors can take advantage of the market's ups and downs while maintaining a disciplined approach to investing. Rebalancing in bear markets. Another important aspect of index fund investing in bear markets is portfolio rebalancing. Rebalancing involves periodically adjusting the allocation of assets in a portfolio to maintain the desired risk and return profile. During bear markets, certain asset classes may experience larger declines than others, leading to an imbalance in the portfolio's asset allocation. Rebalancing allows investors to sell assets that have performed well and buy assets that have underperformed, bringing the portfolio back to its target allocation. This disciplined approach ensures that investors are not overly exposed to a particular asset class and helps to manage risk during volatile market conditions. Index funds can simplify the rebalancing process due to their broad market exposure. By investing in index funds that cover different asset classes, such as stocks, bonds, and real estate, investors can easily rebalance their portfolios by adjusting their allocation to each index fund. This ensures that the portfolio remains diversified and aligned with the investor's long-term goals. Conclusion. While bear markets can be challenging for investors, index funds offer a reliable and disciplined approach to navigate through these periods of market decline. By providing broad market exposure, low costs, and a long-term investment perspective, index funds can help investors weather the storm and potentially benefit from the eventual market recovery. During bear markets, it's important for investors to stay focused on their long-term goals and avoid making impulsive investment decisions based on short-term market fluctuations. By maintaining a diversified portfolio, implementing dollar-cost averaging, and periodically rebalancing, index fund investors can position themselves for long-term success, even in the face of a bear market. 11.4 Adapting your index fund strategy to market conditions. As an index fund investor, it is important to understand that market conditions can change over time. The performance of different asset classes and sectors can vary, and it is crucial to adapt your index fund strategy accordingly. In this section, we will explore some key considerations for adapting your index fund strategy to market conditions. Stay informed and monitor market trends. To effectively adapt your index fund strategy, it is essential to stay informed about market trends and developments. This includes keeping track of economic indicators, industry news, and market sentiment. By staying informed, you can identify potential shifts in market conditions and make informed decisions about your index fund investments. One way to stay informed is by regularly reviewing financial news and analysis from reputable sources. This can help you understand the factors influencing the market and identify any emerging trends or risks. Additionally, monitoring the performance of different asset classes and sectors can provide insights into market conditions and help you make informed decisions about your index fund allocations. Rebalance your portfolio regularly. Rebalancing your index fund portfolio is an important strategy for adapting to changing market conditions. Rebalancing involves adjusting the allocation of your investments to maintain your desired asset allocation. This means selling some investments that have performed well and buying more of those that have underperformed. By rebalancing, you can ensure that your portfolio remains aligned with your long-term investment goals and risk tolerance. It helps you take advantage of market fluctuations by buying low and selling high. For example, if a particular sector or asset class has experienced significant gains, rebalancing allows you to take profits and reinvest in areas that may offer better potential returns. The frequency of rebalancing depends on your investment strategy and personal preferences. Some investors choose to rebalance on a set schedule, such as quarterly or annually, while others rebalance when their portfolio deviates significantly from their target allocation. Regardless of the approach, regular rebalancing helps you adapt to changing market conditions and maintain a disciplined investment approach. Consider sector rotation. Sector rotation is a strategy that involves shifting your investments among different sectors based on their relative performance and market conditions. This strategy aims to capitalize on the cyclical nature of sectors, as different sectors tend to outperform or underperform at different stages of the economic cycle. To implement sector rotation, you can use sector-specific index funds or exchange-traded funds, ETFs, that track the performance of specific sectors. By monitoring the performance of different sectors and adjusting your allocations accordingly, you can potentially enhance your returns and manage risk. However, it is important to note that sector rotation requires careful analysis and research. It is not a guaranteed strategy for outperforming the market, and it can be challenging to accurately predict sector performance. Therefore, if you choose to implement sector rotation, it is crucial to conduct thorough research and consider the potential risks involved. Diversify across asset classes and geographies. Diversification is a fundamental principle of investing, and it becomes even more important when adapting your index fund strategy to market conditions. By diversifying across different asset classes and geographies, you can reduce the impact of any single investment or sector on your portfolio. Diversification helps you manage risk and potentially enhance returns by spreading your investments across a range of assets that may perform differently under various market conditions. For example, during periods of economic uncertainty, certain asset classes like bonds or gold may provide a hedge against volatility in the stock market. To achieve diversification, consider investing in a mix of index funds that cover different asset classes, such as stocks, bonds, and real estate. Additionally, consider diversifying geographically by including international index funds in your portfolio. This can help you benefit from global economic growth and reduce the risk associated with a single country or region. Be mindful of costs and fees. When adapting your index fund strategy to market conditions, it is important to be mindful of costs and fees. While index funds are known for their low expenses compared to actively managed funds, it is still important to consider the impact of fees on your overall returns. High fees can erode your investment returns over time, especially during periods of lower market returns. Therefore, it is important to choose index funds with low expense ratios and be aware of any additional fees, such as transaction costs or account maintenance fees. Additionally, consider the tax implications of your index fund investments. Taxes can impact your overall returns, especially if you hold index funds in taxable accounts. By being mindful of costs and taxes, you can maximize the efficiency of your index fund strategy and potentially enhance your long-term returns. Conclusion: adapting your index fund strategy to market conditions is crucial for long-term investment success. By staying informed, regularly rebalancing your portfolio, considering sector rotation, diversifying across asset classes and geographies, and being mindful of costs and fees, you can navigate changing market conditions and potentially enhance your investment returns. Remember, it is important to align your index fund strategy with your long-term investment goals and risk tolerance, and to consult with a financial advisor if needed. 12. The future of index fund investing. 12.1 Trends in index fund industry. The index fund industry has experienced significant growth and evolution over the years. As more investors recognize the benefits of index fund investing, the industry has responded by introducing new products and strategies to meet the changing demands of investors. In this section, we will explore some of the key trends in the index fund industry and how they are shaping the future of index fund investing. 1. Increasing popularity of index funds. One of the most notable trends in the index fund industry is the increasing popularity of index funds among investors. This can be attributed to several factors. First, index funds offer a low-cost and efficient way to gain exposure to a diversified portfolio of securities. With their passive management approach, index funds aim to replicate the performance of a specific market index, such as the S&P 500 or the FTSE 100. This simplicity and transparency have resonated with investors who value a straightforward investment approach. Second, the consistent outperformance of many index funds compared to actively managed funds has also contributed to their popularity. Numerous studies have shown that the majority of actively managed funds fail to beat their respective benchmarks over the long term. As a result, investors have increasingly turned to index funds as a way to achieve market returns at a lower cost. 2. Expansion of index fund offerings. Another trend in the index fund industry is the expansion of index fund offerings. Initially, index funds were primarily focused on tracking broad market indices, such as the S&P 500. However, as investor demand has grown, so too has the variety of index funds available. Today, investors can choose from a wide range of index funds that track specific sectors, industries, asset classes, and even socially responsible investing criteria. This expansion of index fund offerings has allowed investors to tailor their portfolios to their specific investment goals and preferences. Whether an investor wants exposure to a specific sector like technology or wishes to invest in companies that align with their values, there is likely an index fund available to meet their needs. 3. Rise of ESG and SRI index funds. Environmental, social, and governance (ESG) investing and socially responsible investing (SRI) have gained significant traction in recent years. As a result, there has been a surge in the development of ESG and SRI index funds. These funds aim to incorporate ESG factors into the investment process by selecting companies that demonstrate strong environmental, social, and governance practices. ESG and SRI index funds provide investors with an opportunity to align their investments with their values without sacrificing diversification or performance. This trend reflects the growing awareness and importance of sustainability and responsible investing in the investment community. 4. Innovation in smart beta strategies. Smart beta strategies have emerged as another trend in the index fund industry. Smart beta refers to index funds that deviate from traditional market cap-weighted indices and instead use alternative weighting schemes based on factors such as value, momentum, or low volatility. These strategies aim to provide investors with enhanced risk-adjusted returns compared to traditional market cap-weighted index funds. The introduction of smart beta strategies has allowed investors to access different sources of risk and return beyond traditional market indices. By incorporating factors that have historically been associated with outperformance, smart beta strategies offer investors the potential for improved risk-adjusted returns. 5. Continued fee compression. Fee compression has been an ongoing trend in the investment industry, and index funds have been at the forefront of this movement. As more investors gravitate towards low-cost index funds, fund providers have been under pressure to reduce fees to remain competitive. This has resulted in a significant decrease in the expense ratios of index funds over the years. The continued fee compression in the index fund industry has been beneficial for investors, as lower fees translate into higher net returns. This trend has also forced active fund managers to reassess their fee structures and justify the higher costs associated with active management. 6. Integration of technology. Technology has played a crucial role in shaping the index fund industry. The rise of robo-advisors and online brokerage platforms has made it easier than ever for investors to access and invest in index funds. These platforms offer automated investment solutions that utilize index funds as a core component of their portfolios. Additionally, advancements in data analytics and artificial intelligence have enabled fund providers to develop more sophisticated index strategies. These technologies allow for the creation of custom indices and the implementation of complex investment strategies, further expanding the possibilities within the index fund industry. In conclusion, the index fund industry is experiencing several significant trends that are shaping the future of index fund investing. The increasing popularity of index funds, the expansion of index fund offerings, the rise of ESG and SRI index funds, the innovation in smart beta strategies, continued fee compression, and the integration of technology are all contributing to the growth and evolution of the industry. As these trends continue to unfold, investors can expect even more opportunities and options within the index fund space. 12.2 Emerging Index Fund Strategies. As the popularity of index funds continues to grow, so does the innovation within the industry. In recent years, there have been several emerging index fund strategies that offer investors new opportunities and potential advantages. These strategies aim to enhance returns, reduce risk, or provide exposure to specific market segments. In this section, we will explore some of these emerging index fund strategies and discuss their potential benefits and considerations. 1. Smart Beta Index Funds. Smart Beta Index Funds, also known as factor-based or strategic beta funds, are a relatively new type of index fund that seeks to outperform traditional market cap-weighted indexes. Unlike traditional index funds that weight securities based on their market capitalization, smart beta funds use alternative weighting schemes based on specific factors or characteristics. These factors can include value, momentum, quality, low volatility, and size, among others. By tilting the portfolio towards securities with desirable factor characteristics, smart beta funds aim to capture excess returns or reduce risk compared to traditional market cap-weighted indexes. Investors considering smart beta index funds should be aware that these strategies may introduce additional risks and complexities. The performance of smart beta funds can be influenced by the chosen factors, and there is no guarantee that these strategies will consistently outperform traditional index funds. 2. Thematic Index Funds. Thematic index funds are designed to provide exposure to specific investment themes or trends. These funds invest in companies that are expected to benefit from long-term structural changes in the economy or society. Examples of thematic index funds include funds focused on renewable energy, artificial intelligence, cybersecurity, or healthcare innovation. Thematic index funds can be appealing to investors who want to align their investments with their personal values or capitalize on emerging trends. However, it's important to note that thematic index funds may be more volatile and concentrated compared to broad market index funds. Investors should carefully evaluate the underlying holdings and consider the potential risks associated with specific themes. 3. ESG Index Funds. Environmental, social, and governance (ESG) index funds have gained significant traction in recent years as investors increasingly prioritize sustainability and responsible investing. These funds incorporate ESG criteria into their investment process, selecting companies that demonstrate strong environmental, social, and governance practices. ESG index funds allow investors to align their investments with their values while still gaining exposure to a diversified portfolio of companies. By investing in companies with positive ESG characteristics, these funds aim to generate competitive financial returns while promoting sustainable business practices. It's important to note that ESG index funds may have different approaches to ESG integration, and the criteria used to select companies may vary. Investors should carefully review the fund's methodology and ensure it aligns with their specific ESG preferences. 4. Multi-factor index funds. Multi-factor index funds combine multiple factors or characteristics to construct a diversified portfolio. These funds aim to capture the benefits of different factors simultaneously, such as value, momentum, and quality, to potentially enhance returns and reduce risk. By diversifying across factors, multi-factor index funds seek to provide a more balanced exposure compared to single-factor funds. This approach can help mitigate the risk of relying too heavily on a single factor that may underperform in certain market conditions. Investors considering multi-factor index funds should be aware that these strategies may have higher expense ratios compared to traditional index funds. Additionally, the performance of multi-factor index funds can be influenced by the chosen factors and the weighting scheme used. 5. Leveraged and inverse index funds. Leveraged and inverse index funds are designed for investors seeking amplified exposure to market movements. Leveraged funds aim to provide a multiple of the daily returns of an underlying index, while inverse funds seek to deliver the opposite performance of the index. These funds can be used for short-term trading strategies or to hedge existing positions. However, leveraged and inverse index funds are typically not suitable for long-term investors due to the compounding effect and potential for increased volatility. Investors considering leveraged and inverse index funds should thoroughly understand the risks involved, including the potential for significant losses in volatile markets. These funds require active monitoring and may not perform as expected over longer holding periods. Conclusion. The emergence of these index fund strategies provides investors with a broader range of options to tailor their investment portfolios to their specific goals and preferences. While these strategies offer potential benefits, it's important for investors to carefully evaluate the risks and considerations associated with each strategy. As with any investment decision, it's crucial to conduct thorough research, understand the underlying methodology, and consider the suitability of these strategies within the context of your overall investment plan. Consulting with a financial advisor can also provide valuable insights and guidance when considering these emerging index fund strategies. 12.3 Technological Innovations in Index Fund Investing. As technology continues to advance at an unprecedented pace, it has permeated every aspect of our lives, including the world of investing. The field of index fund investing is no exception, with numerous technological innovations revolutionizing the way investors approach and engage with index funds. These innovations have not only made investing more accessible and convenient but have also enhanced the efficiency and effectiveness of index fund strategies. In this section, we will explore some of the key technological innovations that have had a significant impact on index fund investing. Robo-advisors. One of the most notable technological innovations in the world of index fund investing is the rise of robo-advisors. Robo-advisors are online platforms that use algorithms and automation to provide investment advice and manage portfolios. These platforms have made it easier than ever for investors to access and invest in index funds. By leveraging technology, robo-advisors can offer low-cost, diversified portfolios tailored to an individual's risk tolerance and investment goals. Robo-advisors have democratized index fund investing by eliminating the need for traditional financial advisors and their associated fees. They provide investors with a user-friendly interface that allows them to easily set up and manage their index fund portfolios. Additionally, robo-advisors often offer features such as automatic rebalancing and tax loss harvesting, which can help optimize portfolio performance and minimize tax liabilities. Mobile apps. The proliferation of smartphones and mobile apps has transformed the way investors interact with their index fund investments. Mobile apps provide investors with real-time access to their portfolios, allowing them to monitor performance, make trades, and stay informed about market trends from anywhere at any time. This level of convenience and accessibility has empowered investors to take a more active role in managing their index fund investments. Furthermore, mobile apps often come equipped with intuitive and user-friendly interfaces, making it easier for novice investors to navigate the complexities of index fund investing. These apps may also offer educational resources, such as articles, videos, and tutorials, to help investors enhance their knowledge and make informed investment decisions. Artificial intelligence and machine learning. Artificial intelligence (AI) and machine learning (ML) technologies have revolutionized many industries, and index fund investing is no exception. AI and ML algorithms can analyze vast amounts of data and identify patterns and trends that may not be apparent to human investors. This enables investors to make more informed decisions and potentially improve the performance of their index fund portfolios. AI and ML algorithms can be used to develop sophisticated investment models that take into account various factors, such as market conditions, economic indicators, and company fundamentals. These models can help investors identify undervalued or overvalued securities, optimize asset allocation, and even predict market movements. By leveraging AI and ML technologies, investors can gain a competitive edge in the index fund market and potentially achieve better risk-adjusted returns. Blockchain technology. Blockchain technology, which underpins cryptocurrencies like Bitcoin, has the potential to revolutionize the way index funds are structured and operated. Blockchain technology offers transparency, security, and immutability, which can address some of the challenges associated with traditional index fund structures. By utilizing blockchain technology, index fund managers can create decentralized and transparent systems that allow investors to verify the holdings and performance of the fund in real time. This level of transparency can help build trust between investors and fund managers, as it eliminates the need for intermediaries and reduces the risk of fraud or manipulation. Additionally, blockchain technology can facilitate the creation of tokenized index funds, where shares of the fund are represented by digital tokens. This opens up new possibilities for fractional ownership, increased liquidity, and streamlined settlement processes. Tokenized index funds can be traded on decentralized exchanges, providing investors with greater flexibility and accessibility. Big data and predictive analytics. The advent of big data and predictive analytics has transformed the way investors analyze and interpret market information. By harnessing the power of big data, investors can access a wealth of information from various sources, such as financial statements, news articles, social media, and web traffic. This data can be analyzed using predictive analytics algorithms to identify trends, sentiment, and market signals that can inform investment decisions. In the context of index fund investing, big data and predictive analytics can help investors identify potential risks and opportunities, optimize portfolio construction, and enhance risk management strategies. By leveraging these technologies, investors can gain deeper insights into market dynamics and make more informed decisions based on data-driven analysis. Conclusion. Technological innovations have had a profound impact on index fund investing, making it more accessible, efficient, and effective. Robo-advisors have democratized investing, Mobile apps have empowered investors with real-time access to their portfolios, AI and ML technologies have enhanced decision-making processes, blockchain technology has introduced transparency and security, and big data and predictive analytics have provided investors with valuable insights. As technology continues to evolve, it is likely that we will witness further advancements in index fund investing, enabling investors to achieve their financial goals with greater ease and efficiency. 12.4 The role of index funds in a changing investment landscape. Index funds have become increasingly popular among investors in recent years, and their role in the investment landscape continues to evolve. As the financial markets and investment strategies change, index funds have proven to be a reliable and effective tool for investors seeking long-term growth and diversification. In this section, we will explore the role of index funds in a changing investment landscape and discuss their advantages and potential challenges. The rise of passive investing. One of the key factors driving the growth of index funds is the rise of passive investing. Passive investing refers to a strategy where investors aim to replicate the performance of a specific market index, such as the S&P 500, rather than trying to outperform it. This approach is in contrast to active investing, where fund managers attempt to beat the market through stock selection and market timing. Index funds are designed to provide broad market exposure and low-cost diversification. They achieve this by holding a portfolio of securities that closely mirrors the composition of a specific index. By investing in index funds, investors can gain exposure to a wide range of stocks or bonds, depending on the fund's focus, without the need for extensive research or active management. Advantages of index funds. Index funds offer several advantages that make them attractive to investors. First and foremost, they tend to have lower expense ratios compared to actively managed funds. This is because index funds do not require the same level of research and analysis as actively managed funds, which often have higher management fees. Another advantage of index funds is their potential for tax efficiency. Since index funds have low turnover, they generate fewer capital gains distributions, resulting in lower tax liabilities for investors. Additionally, index funds are passively managed, which means they have lower trading costs compared to actively managed funds. Furthermore, index funds provide broad market exposure, allowing investors to participate in the overall performance of the market or a specific sector. This can be particularly beneficial for investors who prefer a long-term, buy-and-hold strategy. By investing in index funds, investors can capture the returns of the market without the need for constant monitoring or active trading. Challenges and considerations. While index funds offer many advantages, there are also some challenges and considerations that investors should be aware of. One potential challenge is the risk of tracking error. Tracking error refers to the discrepancy between the performance of an index fund and its underlying index. Factors such as fees, trading costs, and sampling methods can contribute to tracking error. While tracking error is generally small, it can impact the fund's performance relative to its benchmark. Another consideration is the potential lack of flexibility in index funds. Since index funds aim to replicate the performance of a specific index, they are constrained by the index's composition and weighting methodology. This means that index funds may not be able to take advantage of certain investment opportunities or adjust their holdings based on market conditions. Additionally, index funds may not be suitable for investors who prefer an active investment approach or have specific investment goals that require a more tailored strategy. While index funds provide broad market exposure, they may not be able to outperform the market or generate alpha, which is the excess return above the market return. The role of index funds in a changing investment landscape. Despite these challenges, index funds continue to play a significant role in the changing investment landscape. As investors become more cost-conscious and seek transparency in their investments, index funds offer a simple and efficient way to gain exposure to the market. The growth of index funds has also led to increased competition among fund providers, resulting in lower fees and more choices for investors. Furthermore, the rise of environmental, social, and governance (ESG) investing has also influenced the role of index funds. ESG index funds have emerged to meet the demand for socially responsible investing. These funds incorporate ESG criteria into their investment process, allowing investors to align their investments with their values while still benefiting from the diversification and low costs associated with index funds. In conclusion, index funds have become an integral part of the investment landscape, providing investors with a cost-effective and diversified approach to long-term investing. While they may not be suitable for all investors or investment strategies, index funds offer a reliable and efficient way to participate in the market's performance. As the investment landscape continues to evolve, index funds are likely to adapt and innovate to meet the changing needs of investors.